Up for a pretty weak performance this week on iron ore, Thomas, and we'll keep that in mind as we look at what happens with the mining stocks this morning. The pound was holding on to gains, just a little weaker now, 127.56, on the back of that GDP number that did beat estimates, but still suggests some weakness around the UK growth story.
Yeah, here in the UK, FTSE 100 futures flagging gains of 0.5%, a slightly stronger picture being painted by the DAX futures, looking to add close to 100 points. Over in France, the CAC 40 looking to add around 27 points, pointing high by 0.4%.
Okay, so the market's then just opening up around European equities, so we'll see if we get that bounce at the start of trade that we've been flagging this morning. The FTSE 100 up by 0.2%. Here's the muted performance we see on FX markets. Not a huge amount of money flowing with risk aversion in mind into the US dollar, it would seem. A lot of commentary on the Markets Live blog about whether the dollar is actually much more focused on the Fed rate cut trajectory, and of course markets almost pricing in a cut in March. Not fully anymore, but they are thinking about that. Our guest in the last hour talking about cuts starting in May, of course. This is the sovereign bond column. We are seeing buying of sovereign bonds, and we're seeing those yields come down. Is that a risk aversion trade, or is it again to do with interest rate differentials and that trajectory? Here's commodities. It looks all green now. The iron ore price through the Asia session, though, has looked weaker, so we'll keep that in mind. But of course, the geopolitical tension is evident in oil prices, up by more than 2% on Brent and on WTI. Worth watching those gas prices as well. A little bit of a jump higher in gas prices, as we could see disruption, yes, to waterborne shipping exports from through the Straits of Hormuz, and so that's Iraq and Kuwait and Saudi, but also Qatari gas could be in focus as well, and so the market will increasingly think about that, even if that's not the level of disruption that we are actually pricing in right now. The positive picture then on equity markets is in play, Tom, this morning, up by 0.6% on the FTSE. What do you see in terms of the sectors? Well,
within energy as a sector, you're seeing gains of a little over 1%. No big surprise there, given the upside we've seen coming through from Brent and WTI. What's interesting, though, is that Basic Resources, despite the softness that we're seeing, quite pronounced softness in iron ore prices this morning, Basic Resources actually gaining as a sector a little over 1%. We know that copper has been going against the grain and is actually up in the session today. Maybe that is a component of it, but that's interesting given the deflationary picture that continues out of China as well. One sector firmly in negative territory so far, and an overall positive session for European equities in the first opening sessions, of course, first opening minutes, is the consumer sector, and therein lies luxury and the Burberry story, with that downgrade to their forecast on a weaker than expected December, and as a sector that is down a full 1.2%. Also worth noting, tech is doing pretty well so far in the session, again there of a little under 1%. You saw the Nasdaq posting gains yesterday, modest gains, but that continues to grind higher, the story around US tech. Across your benchmark here in Europe, gains of 0.5%, holding at 475.
Yes, you're absolutely right, Tom. So Basic Resources, the best performing sector, energy not far behind it this morning. Let's think about the geopolitical tension and where we head from here. American and British forces have launched airstrikes on more than 60 Houthi targets in Yemen. The military action comes after weeks of attacks by the Iran-backed Houthis on commercial ships in the Red Sea. Joining us now with the latest developments overnight, Yusuf Gamal Eldin joins us now from Dubai. Yusuf, what more can you tell us about these strikes and what the US and the UK have said about them?
So the statement so far indicates, Anna, that you have 60 targets that were in play, that across 16 locations in the Houthi-controlled areas. Now, those include missile launchers, cruise missiles, radar installations, a long list of targets that they say they've been able to take out. What's not clear is whether there's going to be another wave to further take out any Houthi military assets. But what is clear is that this is a message from the U.S. that they're not going to allow any hostile actors to imperil freedom of navigation in what is one of the world's most critical commercial routes, guys.
Yeah, as you say, a reaction from the US plus its allies, of course, the UK and others. What does the reaction, meanwhile, been from the Houthis and, of course, their backers, Iran?
So far, we have a statement through their television network, and they have indicated that they are going to continue attacking Israeli ships or any ships that are headed to Israel. What isn't clear is whether these latest attacks have been able to actually disable Houthi military capacities. Remember that this is a very agile group. They operate like an insurgency, guerrilla warfare. So taking on enemies in an open sea isn't necessarily what they do day to day. But where you could see a response is through their proxy network, mainly Iran. The Iranians have already put out a statement on Telegram, and they made it clear that the attacks on Yemen's Houthis are going to fuel insecurity. So if you think about the kind of reach that Iran and its proxies have, that could come up not just in the Middle East, but pretty much anywhere in the world. The U.S. has been entangled or keeps getting entangled in Yemen all the way back since the events of USS Cole about a year before 9/11, guys.
Okay, Yusuf Gamal Adin, Daybreak Middle East anchor, of course, with the latest in terms of that military action by the US and the UK on those Houthi targets in Yemen and the potential fallout. Let's get more in terms of the market reaction now to those strikes. Oil jumping, of course, on higher than average volumes today. Let's bring in Stephen Straczynski, always with the granular detail on these energy markets. Stephen, how is the market then reacting? What do you make of this market reaction to these strikes when it comes to oil and energy?
You know, to be absolutely honest, this reaction is, I think, smaller than some people expected. Yes, this is a jump. Yes, prices are up over 2%. But if this had happened maybe a year ago or 2 years ago, you would have seen a much greater reaction when the market was more on edge. In the past, these sorts of geopolitical events would usually see larger spikes, but at 2%, while it is a rise and while there is stress and the war premium is being built back into Brent crude and WTI prices, it isn't reacting the way that they had in the past. And I think that's mostly because there is this tug of war, as one analyst said, between the war risk and also just the fundamentals of the oil market. Things are looking, you know, a bit frothy in the oil market at the moment. Supply is pretty strong out there, and it's not just OPEC Plus and Middle Eastern supply. It is supply out of the United States. It's that shale supply that has remained pretty strong. So while this tension in the Middle East could wind and bring in other producers and affect supply and trade of the fuel, I think you're looking immediately at the fundamentals. No oil production has been affected yet. Red Sea travel, while there is a risk that that could continue to be disrupted, overall you are looking at a market that is a bit oversupplied and a bit more bearish when you look at it.
Yeah, so Stephen, so what we're looking at right now is a risk that more oil and other energy products have to take the long way round rather than going through the Suez Canal. But what we're not talking about is the closure of the Straits of Hormuz or disruption to a third of the world's waterborne oil exports. But if we were talking about that, that's where the risks lie, I guess.
Absolutely. You hit the nail on the head. That is the big risk, right? So if there is this tension, this proxy war kind of spinning out between the United States and Iran decides to, halt the Strait of Hormuz, that would have an enormous impact, not just on oil prices, and you could see oil prices spike. And one analyst said that that could be worse than the oil crisis of the 1970s. That's an absolute worst case scenario. Now, that is still just a risk, right? Iran isn't threatening to do that. We're not seeing that at the moment, but if this tension between the U.S. and Iran does escalate, that is something that could happen. That's one of those risks that the market is going to have to price in. And again, as you mentioned, that's not just oil. That's liquefied natural gas. That's going to affect exports of LNG from Qatar to the rest of the world. They have to take that vital waterway to get the LNG to Europe, to Asia, and Qatar is the world's biggest exporter of LNG. So that would affect an enormous amount of supply, and that would have a huge impact. But still, we're not there yet. That's going to be something that the market is going to be monitoring very closely, especially as we get responses from Iran and the United States.
Yeah, we continue to watch that then, up by 2.5% now on Brent at 79.31. Stephen, thank you. Bloomberg, Stephen Sapczynski joining us with the latest on the oil market. Coming up, we'll get an update on some of the stocks that are on the move this morning. One of those is Burberry, really falling this morning after lowering its profit forecast following weak December sales. The stock down 11.7% right now. The luxury goods company saying that sales declined in the key Christmas season and slashing its profit forecast after already warning that earnings would be at the low end. We'll get you an update. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg. This is Markets Today, 11 minutes into our European trading day, and in defiance of the geopolitics, no risk aversion evident in European equity markets this morning. We are seeing European stocks pretty strong, up by 0.9% on the Stoxx 600. The FTSE 100 on pace with that, as is the DAX, and almost in the case of the CAC as well. Let's get an update on the individual stocks behind these moves. Joe Easton has a briefing. Joe.
So we had a massive move in Burberry at the open, down 15%. It was the biggest drop since 2012 for that stock. Following that shock profit warning, it's come back up a bit now, down 9%. But we are also seeing a feed through in LVMH, Kering and Richemont. All of these companies will start reporting earnings at the back end of this month as well. So it's an indicator of what's going to go on there. And what's shocked investors today is the fact that Burberry only warned on their sales around 2 months ago. They didn't expect this warning. We weren't expecting it today. And that is why we're seeing a huge drop in some of those shares. Coming back down further now, down around 9% on Burberry. Keep an eye on that luxury sector. In Europe today, those stocks falling out of fashion today. That's the best I can come up with on short notice following that surprise warning. But in terms of those shipping firms, we're seeing them coming up after those tensions reignited in the Red Sea last night. The UK and the US launching those attacks on Houthi rebel bases, potentially signaling a retaliation. And those shares, Maersk and Hapag-Lloyd, rising more than 2% in early trading. And in terms of a couple of earnings stories we've got today, Jerónimo Martins, this is a grocery firm out of Portugal, warning that declining food price inflation is now hurting their profits. Could that be something that we see across the sector as we get more earnings out of grocers? We already had weakness from Sainsbury's earlier this week, so potentially an indicator there. And Vinci, this is over in France. It's airport services, construction. They've got some free cash flow numbers, doing pretty well for that one. On the final board, we have an eclectic mix. Pagero, a bidding war for that one. A rival firm in the US is countering Thomson Reuters bid. So we're seeing that one jumping again. It jumped yesterday, up another 11%. Reports from the Wall Street Journal that Novartis is now dropping its bid for Psychokinetics. This was a company that they were said to be bidding $9 billion for. The stock plunged in the US yesterday. Novartis coming up a bit on that news. And a couple of broker moves we had. Morgan Stanley is downgrading a few of the chemicals firms today, including IMCD. That one dropped at the open in Amsterdam, but it's coming back up a little bit now, almost unchanged. And Ceres Power, a power company out of the UK, downgraded to underperform at RBC. They've got some capital issues, and that one is down around 5%.
Joe, thanks very much. Joe Easton from our equities team with an update on what's happening on these markets this morning.
OK, now the UK economy enjoyed a modest rebound in November, leaving the prospect of a technical recession on a knife edge. For the analysis, let's bring in Melanie Baker, Senior Economist at Royal London Asset Management. Melanie, good morning. Thanks for joining us this morning. What do you make of the numbers? Are we now in a place where we can avoid a recession here in the UK, given the modest uptick in growth?
Still too early to say. I've had a view that the UK would be in mild recession sort of around the turn of the year for a while. I'm still comfortable with that view. I mean, even if we get, a small rebound in, say, December GDP, and we avoid a technical recession, you're a whisker away in terms of back revisions of ending up in technical recession after all. I mean, it just feels like a very broken record with the UK. It's been up, down, and generally the economy has just been flat for so long.
Yeah, when we look at the monthly data, yes, around GDP, it's sort of negative, positive, positive. It's sort of all over the place, isn't it? But all of that seeming pretty flat. In terms of the politics then, and whether any of the politics that will play out in the next 12 months or so can take us anywhere higher in terms of the GDP story, either with a new leadership and a new party in charge, or with a sort of reinvigorated existing one. Of course, we know what the polls suggest. But given the fiscal barriers that remain for the UK around what it can do, what are you expecting to see on that side? What contribution can the fiscal side make?
I mean, there's always a chance we get a last-minute kind of burst of fiscal stimulus. It temporarily helps things in a way. But you're right. I mean, the big picture is the fiscal ability of any government to really push fiscal spending and steer the economy through fiscal is really limited. I mean, if you look at any long-term projections of the UK debt, the path that we're on at the moment just looks unsustainable. And that's demographics, that's population aging. It's a similar story in Europe, of course, as well. Government's room for manoeuvre is kind of constrained still in that kind of big picture sense. But there's always something governments can do in terms of boosting, say, productivity growth, all those things that really matter for long-term potential output. But for that, those things take a really long time to work and require kind of long-term thinking.
Melanie, how much clarity do you and the team have in terms of these long and variable lags of higher interest rates? We're at a benchmark of 5.25%. How much of that has been passed on now to the real economy here?
It's really difficult to say, actually, and there's quite a bit of disagreement, it seems, among economists over, whether we've seen the peak. Maybe we're past it already. You have others who think there's lots more to come. I mean, for me, I'm assuming that we haven't quite seen the peak of the impact yet. I thought the analysis done by Resolution Foundation last week was really quite interesting. The idea that savers gained, that effect came through quite fast and quite strong in the UK, and that maybe now the effect we see now switches more to the effect on mortgage payers kind of dominating, and therefore more of a hit kind of coming through in aggregate for UK households.
Yes. So does that mean we're in a sort of rate sweet spot where we've had the positives and we haven't yet got the negatives? That sweet spot only adds up to a pretty lackluster, in your language, growth picture. But so is there risk to the downside then, do you think, for the UK? Because of that mortgage risk?
I think that there are risks to both sides. As I say, I have a fairly downbeat but an awful view on the UK economy. I think for me, one of the really interesting things at the moment is going to be what happens actually to the inflation picture from here as well. Because one of the really big positives people had talked about for the UK and actually for lots of economies have been the idea that, okay, where pay growth is probably going to stay relatively robust this year, but with much lower inflation, we're going to see people's pay packets go further. We're going to see a bit of support for the consumer as the year goes on. So I'll be keeping a really close eye on what these inflation risks, obviously a topic for this morning, and how those evolve in particular.
Yeah, and of course the Bank of England will be paying close attention to those inflation picture as well, that inflation trajectory. Where do you land? The team at Bloomberg Economics have actually pulled forward their expectations for a cut from the Bank of England to May. Does that sound reasonable to you? How are you thinking about the sequencing?
Yeah, it's reasonable. My forecast it'll be Q3, but whether it's sort of May or August, it's not really a big difference in the scheme of things. So I've got 50 basis points of cuts in the second half of the year as a central case. But as I said, given all the cross currents in the economy and inflation, I mean, things feel like they could go either side of that forecast at the moment.
And we wait for the budgets a little bit later on. Does that, again, back to our earlier conversation, does that not really move the needle?
I'm not expecting it to. There's always a risk.
Okay, Melanie Baker, senior economist at Royal London Asset Management, on this GDP data out of the UK that came in marginally higher than expected, but as we've been discussing, still can't call a close on the potential recession risk, technical recession risk for the UK. Watching, of course, very closely how the inflation story unfolds in the UK and whether or not that gives us a bit of a bump towards the second half of the year, with 50 basis points of cuts being flagged and forecast by Melanie. Thank you very much indeed. Coming up, after the bumper rally for bank stocks in the last year, particularly towards the end of the year, the sector faces a test, of course, with a high-stakes earnings season. It kicks off today in the US. We're going to have that preview for you. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
welcome back. This is Markets Today. 22 minutes into our European trading day, which is looking actually quite positive, up by nearly 1% now on European stocks. Some catch up, of course, that the team helps me focus on with regards to the way that the US traded yesterday, but perhaps a little surprising still, given what we saw in futures. So up by nearly 1% on the stock 600. One sector that's not doing great is the luxury sector. Let's just focus in on that for a moment then, Tom. We've got Burberry underperforming this morning. Burberry falling after this surprise profit warning coming through from the business. One of the analysts on this story saying self-help is difficult at the best of times and close to impossible when the market is tough, and the market does seem to be tough for these stocks. These are the performers of Burberry today, down by 7.9%. Other stocks down in sympathy. The performance over the last 12 months, though, hasn't been stellar for this sector.
Yeah, it's a challenging story for Burberry right now, but you can see the ripple effects, of course, as other luxury stocks react to the downside that's come through from Burberry and this surprise profit down forecast. In terms of the adjusted operating profit, they now see around 410 to 460 million pounds. So that's down, of course, on the previous forecasts. And they are trying, of course, entice shoppers back. They've revamped the lineup in terms of bringing in a new designer. But so far, of course, it doesn't seem like it's paying dividends. Of course, the China story is important as well when it comes to the luxury space. But currently, that sector taking a big hit.
Okay, let's focus in on the banking sector. We're going to get Wall Street earnings coming through today. Major US lenders, including JP Morgan, Citi, Wells Fargo and Bank of America, are due to report later today. For more, let's get to Bloomberg's finance team leader, who's here on set with us, Jenny Serrane. Jenny, nice to speak to you. So what are you expecting from today's reporting? What's the big story?
I think, so these are our fourth quarter earnings. We've got the last 3 months of the year, but I honestly think most investors are going to be looking straight past fourth quarter and really looking for what these banks say about 2024. So you were expecting rate cuts this year. What will that do to net interest income? We're expecting, or we're hoping, I guess, for this deal-making revival, this long-awaited deal-making revival. Do they really expect that to come to fruition and when? So I think that's what we're going to be seeing from a lot of these banks today, is really just trying to telegraph what's to come in the months ahead. Yeah,
okay, so we zero in on the outlook then, zero in on the outlook. You talk about the trading activity. Are you getting any sense, are you seeing any signs that the trading activity, those operations are coming back?
You know, it's hard to say. I feel like these banks are a lot like Goldilocks and the Three Bears on that. They talk a lot about, we need this volatility, and there really wasn't enough volatility in the fourth quarter to sustain the trading desks of these big banks. But then there was also too much volatility for corporates to get back on the activity for M&A or underwriting. And so I think, we're still a little bit of wait and see mode. It'll be interesting, today if they talk a lot about, wanting to see these Wall Street operations really, kind of powering their earnings from here.
Yeah, and what about the US consumer? We were talking in the last hour of the program about those who were getting into difficulty with credit cards, for example, and that number seems to be on the rise, particularly for certain age groups. So what are we expecting to see there?
Yeah, it's kind of interesting. So we're expecting all these banks to be setting aside a lot more in provisions for those souring loans. But really so far, while net charge-offs have been on the rise, they're still kind of below that pre-pandemic level. So that will be the key takeaway for today. Do these banks expect net charge-offs to get back above the pre-pandemic level? So far, that hasn't been the case. It's been a really strong year for the U.S. consumer. But obviously, with a softening economy, we might start to see them kind of, ringing the alarm bells a little bit there.
Okay, Jennifer Serrane from our finance team, leading our finance coverage here in the UK. As we look ahead as well, preview those bank earnings out of the US later today. Some big names, of course, including the likes of Wells Fargo and BlackRock. Coming up, Taiwan, back to geopolitics and domestic politics. Taiwan going to the polls this weekend in an election that's seen as the world's first major democratic test and geopolitical test in 2024. That is coming up next. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asins is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Houthi militants vow to expand their response to US and UK strikes on targets in Yemen. Oil prices rise on fears of a widening conflict. European indices open higher while S&P 500 futures are off morning lows after data shows US inflation accelerated at the end of 2023, putting rate cut hopes in peril. And Burberry shares take a tumble after the luxury clothing retailer slashes profit forecasts, citing weakened global demand. Welcome back to the program. So, Tom, we've got a host of different factors to deal with. Quite a strong performance for risk assets, for stocks this morning, playing catch-up with the US performance on Wall Street yesterday. But overlay on top of that, a lot of geopolitical concern now, some of it affecting markets and some of it not.
Yeah, for the equity markets, at least for now, seeming to look through the geopolitical angst. You are seeing, of course, an uptick in terms of the energy sector, shipping costs as well. So some of the shipping liners listed in Europe are actually benefiting from the geopolitical increase in tensions there. Across your benchmark, it's a solid day so far this Friday across European equities, up a full percentage point. The DAX at 16,703, 156 points being added to the German index. And here in the UK, the FTSE 100 at 7,643, adding close to 0.9%, despite the fact that we got GDP data suggesting that we are still potentially on the brink of a technical recession. Yes, the numbers did edge up a little bit higher than expected, but a recession cannot be ruled out here in the UK. We flip the board and have a look at the sector moves then. A lot of this is driven, it seems, by money moving into the debt markets as well, particularly pronounced in Europe, UK. Gilts are bid and yields are coming down, so that's benefiting the likes of the real estate sector. And the deflationary lags coming through from China. Yes, the demand for the likes of iron ore is soft and iron ore prices have come off, but maybe that deflationary impulse will benefit in terms of lower inflation for the developed world, for the likes of the UK, the Europe and the US in the months and quarters ahead. Here's the picture then across your sectors. Industrials performing very well, up 1.6%. The energy story is there with those Brent and WTI prices higher, of course, on that geopolitical risk component. Energy as a sector gaining 1%. Basic resources also seeing an uplift despite the pressure coming through on iron ore prices and the concerns about that China demand. Tech is also worth noting because that sector is performing strongly so far in the session, up 1.5%. Autos just on the baseline as a sector, flat essentially after a few days of decent gains for the auto sector. It's worth noting as well what's happening for the consumer segment. Gains of just 0.1%, performing less well than other sectors and largely as a result of the downdraft that's coming through from luxury, and Burberry can certainly be blamed for that with the forecast, the surprise cut to their profit forecasts, sales in December weaker than they expected. Across your benchmark then, gains now of a little over 1%, Anna.
Okay, so clearly the geopolitical event of the moment is what's been happening in the Red Sea over the last 24 hours. But there are other geopolitical concerns to focus in on, and let's do that now. Taiwan's presidential election is set to take place this weekend in a closely fought three-way contest among the first of many elections around the world in 2024. Relations with China and rising prices for households are key issues for voters. Let us have a conversation about that now. We're joined by Yu Jie, who is Senior Research Fellow on China at Chatham House. Very nice to have you with us, Jie, and thank you for coming to talk to us. So for the global audience, what message do you think we are going to take away from this election in Taiwan? A lot of our focus, of course, is on relations between Beijing and Taipei, but other things will be in the minds of voters when they go to the polls. So what's going to be the key message, do you think, to watch for here?
Well, the key message in here is, firstly, it's something quite unpredictable because we have three major political party that is trying to grabbing as much vote as possible in the next 24 hours or so. So hence, who will be the final winner? We're not quite sure at this stage, which is different from the previous election. So on the other hand, the background is a deteriorating U.S.-China relations. So this make the pressure become even more intense, that adding the increasing unpredictability in here. So I think that being unpredictable is really the key feature for this. But I think also this largely looming large by saying everything the election is not just about cross-strait relation, but it's also about which political party that is able to provide a proper economic answer for the Taiwanese population's concern in here as well.
Yeah, the domestic factor is clearly essential as well to the people of Taiwan as we kind of obsess around the geopolitics and the relationship between Taipei, Beijing, and of course Washington. Yu Jie, good morning. Thanks for joining us on this. What is your expectation, the playbook from Beijing in terms of the response if we get a continuation in terms of DPP power? Of course, Tsai Ing-wen stepping down, but indeed, if we do still get the incumbent, the vice president, Lai Ching-te, winning, what do you expect the Beijing response to be to that scenario?
Well, I think Beijing's playbook has been quite clear so far, and firstly, by increasing economic measures, punitive economic measures against Taiwan, so by slapping on tariffs on Taiwan export and imports. And I think secondly, there's also very intense military pressure, military maneuver across the Taiwan Strait as well. So both economically as well militarily. However, I think this is really nothing new in here. But also at back of mind, we're also going to remember what happened in November last year on the Biden-Xi meeting. And basically, I think both sides has drawn the red line on what is acceptable regarding the current status quo of Taiwan. Then again, I think one of the senior diplomats of China met a very senior official at White House this week as well, has really laid the red line. Exactly. China does not expect the United States to making any further military move on this case. Likewise, I think Beijing is also agree that as long as Taiwan does not declare the so-called de jure independence, the current status quo seems to be the best solution so far.
Yes, talking about the status quo, you point out in your notes that according to opinion polls, most of the population of Taiwan would prefer to maintain the current status quo in terms of that relationship between across the straits. How does China think about that? When China sees that information, what does that mean in China?
Well, I think the Chinese leaders also have to consider this very carefully as well. I mean, around 59% percentage that would prefer to keep the current status quo. So by exercising any military means so far, could not be able to win the hearts and minds of the Taiwanese population. I think obviously the best solution it is to have some kind of peaceful settlement between Taiwan and mainland China. And however, I think Beijing has not really answered that question yet. And I think also on the Taiwan side, I think the three candidates know very well enough. They cannot provoke any further regarding the so-called de jure independence. Otherwise, they could have possibly lose the support from the United States as well. So I think the ball has been playing by both sides, and both of them would know having the current status quo perhaps is the best solution for now.
When we think about the economics and we think about the corporate exposure to Taiwan, of course, our focus shifts to technology. And the Center for Strategic and International Studies pointed out, according to their research, that the quote-unquote Magnificent Seven, so those major tech stocks in the US, whether that's Amazon or NVIDIA, get about 90% of their chips, their semiconductors, from Taiwan. What would your message be to conglomerates, international conglomerates, who have that exposure to Taiwan in terms of hedging some of these risks?
Well, I mean, as a political scientist, I refuse to do any prediction here. But what I can say is that really regarding the relationship between China and Taiwan, Beijing will not view through the lenses of technology. Beijing will only view through the lenses of the governing party's legitimacy. So let's not overestimate Beijing's reliance towards Taiwan in terms of technology, in terms of semiconductors in here. So I think that's also part of the reason why China began to have this very strong drive on scientific and technology self-reliance as well. I think this is also partially to provide some kind of solutions in case there might be a military escalation towards across the street.
Thanks very much. Thanks for your time, Yujia, Senior Research Fellow on China at Chatham House. Thank you very much for joining us. Coming up, we will bring you the latest on the US, UK and allied strikes on some Houthi targets in Yemen in a bid to stop the Iran-backed group's shipping attacks in the Red Sea. That's coming next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Welcome back. This is Markets Today. We are 42 minutes into your European trading day. You're actually seeing a positive session across European stocks, gaining 0.9% across the benchmark, and that's despite the political ratcheting up of tensions, of course, in the Middle East, and particularly around the Red Sea area and region, where Houthi rebels have vowed now to retaliate after American and British forces launched airstrikes on more than 60 targets in Yemen. The military action comes after weeks of attacks by the Iran-backed Houthis On commercial ships in the Red Sea, the Houthi militant group has vowed to continue targeting Israeli ships and any vessels heading towards the country. For the analysis, let's bring in now the details, the context with Jane Kinnemouth, who is Policy and Impact Director at the European Leadership Network. Jane, thanks for joining us. How dangerous a moment is this then, in your opinion?
It is part of a slow but wider escalation of conflict in the Middle East, and it reflects the fact that there are multiple conflicts festering there, including big underlying tensions between Iran, Israel, the US, and now the conflict and violence in Gaza is catalyzing a kind of escalation. So we're seeing this play out on multiple fronts, of which the Red Sea is just one. And it means, of course, this is more complicated than simply an intervention to restore freedom of navigation. Normally, you would expect that there would be very wide international involvement in any operation aimed at maritime security. You know, most of the countries in the region have an interest in maintaining the free flow of shipping through this important waterway, but it has been very difficult for the US to get regional countries on board at this time because this is seen as being linked to the war in Gaza.
Yes, Jane, the US and the UK and others have made the point that this is about freedom of navigation, but as you say, there's a wider backstory to fully understand here. In trying to think about how the Houthis respond to this, what would you expect the impact of this to be?
They will not want to back down, and it's useful to have the longer term context that, you know, this is a group that has been on a huge growth trajectory for 2 decades. 20 years ago, they were a marginal group of very religious militants fighting a guerrilla war against the Yemeni government, you know, in northern Yemen. And 10 years on from that, they were actually in a position to team up with the government they used to be fighting and take power in the Yemeni capital in the context of a big contested political transition in Yemen. In their minds, they're probably succeeding beyond their wildest dreams because they are now having a global impact, and they've become quite popular in the Arab world because they're seen as defending the Palestinians, whereas prior to the Gaza war, they were widely disliked and very isolated. They are quite an authoritarian and repressive movement at home, and they had been, you know, fighting a war with Saudi Arabia for several years. So they will want to continue. They will think that they are succeeding and that, you know, being in confrontation with the US will kind of score them brownie points with their constituency.
And of course, they're an organisation, they're a group that is supported by Iran. Does Iran continue to operate via its proxies, Jane, or do we look to the Strait of Hormuz? How much of a risk is it? How do you quantify the risks of a potential shutdown around the Strait of Hormuz?
So what we've seen in recent years is that Iran has been disrupting shipping and attacking specific tankers rather than the old scenario that people have wargamed in the past of totally shutting down the Strait of Hormuz. And the reason is that, you know, Iran has got a number of important relationships that it wants to protect, especially with China and increasingly now with Gulf Arab oil producers. So if it shuts down shipping in the Strait of Hormuz, it makes itself a lot of enemies with other countries that want to buy and sell oil, whereas it is kind of testing the threshold of what it can get away with, but it's also positioning its attacks as a kind of tit for tat, saying, for example, you know, we are coming under pressure from the US and we are going to respond. So there's a lot of calculations going on as all the major players involved do want to avoid a kind of all-out regional war scenario that would pit Iran and Hezbollah against the US and Israel, and which, you know, the US and Israel are more significant military powers, but that sort of conflict would be hugely destructive for everyone. But we're seeing a lot of testing the boundaries and a lot of things that could spiral out of control, and I think we don't see any political resolution in sight to any of the underlying conflicts.
Yes, and you mentioned that the Houthis have perhaps become more popular in the Arab world given the stance they've taken of late and what they're doing in the Red Sea. I imagine, though, that they would be less popular with the leadership in the region. I'm thinking here of Saudi Arabia, Iraq, Kuwait, Qatar, all of whom's major exports could be disrupted if this does widen. What about that web of relationships do we really need to put front and centre?
I mean, Saudi Arabia has been so strongly opposed to the Houthis that it led a Gulf coalition, including Kuwait and Qatar, to try to dislodge them from power when they took over the Yemeni capital. So they fought an aerial campaign against the Houthis for several years. But they have concluded from that air power alone isn't enough of a strategy, and they have sought instead to use economic levers and hold out to the Houthis the possibility of reconciliation, that the Houthis could come into a power-sharing government in Yemen that would be recognised, and in return they would get some aid and some economic cooperation. So there will be a lot of back-channeling now by countries such as Saudi Arabia and Oman, which has good ties and ability to speak with the Houthis, but it is probably going to require a much broader diplomatic and political strategy to really curb this threat. And now, you know, the Houthis have had a taste of power on a new scale, so that group might move away from wanting to find an accommodation with its neighbours, and the most revolutionary elements in it may be empowered.
Jane, thanks very much. Thanks for bringing us the analysis. Jane Kinninmont, Policy and Impact Director at the European Leadership Network. Let's turn our attention to other geopolitical tensions and war. South Africa is calling on the United Nations International Court of Justice, the ICJ, to order Israel to end its war on Hamas in Gaza. Pretoria wants the ICJ to rule that Israeli military actions constitute genocide. Israel says it's defending its own territory and has worked hard to prevent civilian casualties. ICJ tribunal rulings are binding. However, there is no current mechanism to enforce an order.
South Africa unequivocally condemned the targeting of civilians by Hamas and other Palestinian armed groups and the taking of hostages on the 7th of October 2023, and has again expressly recorded this condemnation, mostly recently in its note verbal to Israel on the 21st of December 2023.
That's the South African perspective then. We know that Israel will put forward its perspective today at the ICJ. Let's get thoughts from Bloomberg's Karen Matusek, who is with us now. Karen, what are the key legal points we need to be aware of when thinking about this? Because genocide has a very specific definition.
Yes, genocide is considered the highest crime that we know under international law, but it's also kind of difficult to prove because you have to prove that the party that's allegedly doing it has a special intent, and the primary intent and the primary goal of any action would be to destroy or kill a group, at least in part. And that's the key issue that's kind of in question here. South Africa yesterday has argued 3 hours with a lot of details saying, you know, look at what's happening in Gaza, you know, look at the death toll, look at the dire situation of the civilians. So that this can't be explained any other way. And they're also citing a lot of political and military leaders who made comments to that effect, at least in the eyes of South Africa. So Israel today will, of course, defend and will say, no, we are not targeting the Palestinians as such. We are targeting Hamas, who has attacked us. So in cases like this, they will take years to resolve this particular issue. So South Africa has asked for a fast ruling in order to stop Israel immediately, to stop the operations to prevent any further harm for the moment.
Yeah, I have to wonder where South Africa was when Russia was committing those atrocities in Bucha in Ukraine. South Africa was silent, but not now. What is the potential impact for Israel and Gaza then when rulings aren't enforceable?
Well, theoretically, the UN could enforce the ruling, but the Security Council, of course, would block any initiative like this. So that's kind of theory. But nevertheless, I mean, South Africa is doing it because if they win a ruling, either it would be a big diplomatic push for them, a political argument. They could align even more people. And for Israel, it's problematic because its key allies kind of do care about these issues, and they do care. It's they want to keep the humanitarian law. So it's a more political thing. Plus, other states could join on either side of the dispute. So it's not without, it keeps the discussion also in public attention. Look at the media that is covering all of this. So it's not nothing.
Okay. Bloomberg's Karen Martusek, thank you very much indeed. Plenty more coming up. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Could face bigger challenges next.
It was going to keep bringing the World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back. This is Markets Today. We're 56 minutes into a European trading day that is positive. Overall, very positive, in fact, catching up with some of the gains on Wall Street yesterday. Not so for the luxury sector, though. That's under pressure. A profit warning coming through from Burberry. Burberry down to 2020 lows. The stock warning really hitting peers, so hitting other stocks within the sector as well, Tom.
Yeah, you're seeing losses coming through for Kering, LVMH, of course, in France, as well as Christian Dior on the back of that outlook downgrade from Burberry. Cross-asset, let's check in, of course, on oil prices and what is happening as well when it comes to FX. The Bloomberg Dollar Index, as you can see, is currently just down, actually, about 0.1%, but oil prices continue to hold up in terms of geopolitical risk, currently up around 2.4%, still just below that $80 a barrel level, though, Anna.
Yeah, stocks Europe is up by 0.9%, so quite strong. Only one sector in negative territory. That's the luxury story we've already talked about. Real estate, one of the best performing sectors, as yields across Europe are dropping this morning. That is it for Markets Today. The Pulse is up next. This is Bloomberg.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Houthi militants have vowed to expand their response to U.S. and U.K. strikes on targets in Yemen, while oil prices rise on fears of a widening conflict. The ECB President Christine Lagarde says the central bank will start cutting rates, but only once it's convinced inflation is headed back to its 2% goal. Plus, recession risk lingers, of course, in the UK, despite a modest rebound in growth for November. So first thing is first, let's take a look at the European markets map. Yesterday, we had a big day, of course, with U.S. inflation. Now, on the back of that inflation forecast, but also very closely looking at what oil prices are doing because of Middle East tensions that are rising. This is a picture across the board in Europe. Now, the FTSE in the UK, you can see getting some 0.8%. We have similar gains for the FTSE MIB over in Milan. The CAC 40 gaining 1%, as is the DAX in Germany. Now, this, I guess, is as traders are sticking to their expectation of U.S. interest rate cuts this year. But again, watch out for oil. It's surging amidst some of these tensions in the Middle East. Now, American and British forces have launched airstrikes on more than 60 Houthi targets in Yemen. Well, Houthis say 5 people were killed in the strikes. They say they won't hesitate to attack the source of the threat. Now, it marks a significant escalation against the Iran-backed group, which has launched weeks of attacks against commercial ships in the Red Sea in protest against Israel's war in Gaza. Now, regional powers, including Saudi Arabia, have called for restraint. So for more on this, we're joined by Annika Treon, Chief Economist at Van Lanschot Kempen, also Julian Lee, an oil strategist here at Bloomberg, joining, of course, the conversation. So thank you both for joining us. Julian, let me start with you. How much do we know about how oil is resistant to all of this?
Well, I think at the moment, at least, this is very much a story about transportation. This is about the ability or otherwise of ships to pass through the Bab el-Mandab at the southern end of the Red Sea and then on through the Suez Canal. The alternative to that, of course, is to go around the southern tip of Africa. The people who are really going to be affected by that, I think, are European buyers of predominantly of Iraqi oil that has to go in that direction. And if they decide to avoid the area, also the Chinese and Indian buyers of Russian oil, which tends to head south through the Red Sea and out into the Indian Ocean. Shipments from the Middle East to the United States they don't tend to go through the Red Sea anyway. They already go around the south of Africa, or they go across the Pacific to the west coast. Saudi exports can be put on ships in the Red Sea and avoid that southern area. So it's very much about transport, unless this really escalates and we start seeing attempts by Iranian proxies to either hit oil production facilities or hamper exports out of the Persian Gulf.
Annika, what's your take on all of this? Again, if you look at markets today, I know you're a longer-term economy, but if you look at markets, they focus more on the fact that there could be a pivot from central banks rather than all of these geopolitical tensions.
Yeah, definitely. I think from a markets perspective, there's three ways of looking at it. The first is quite straightforward, which is markets are pretty much around all-time highs, where there's a lot of uncertainties going on, and this sort of coming up is really illustrating the fact that the geopolitical situation we have in the Middle East could escalate, and how does that go hand in hand with all-time markets, and how nervous should we be and how less competent should we be? That's one. Two is obviously oil price. What your colleague just mentioned there is key, because oil price was one of the biggest drivers for the inflation problem, especially in Europe. And obviously that's finally starting to abate, and everyone's very excited about policy U-turns. But if oil prices to tick up, that totally destroys that story. And the third point is simply about global supply chains. You know, the Red Sea is a 15% global trade route, and we've seen what supply chain bottlenecks can do in terms of pricing pressure around COVID. We obviously don't want to see that again.
Yeah, and to your great point, Annika, let me ask Julian why you think, Julian, that markets, even oil markets, have been more or less taking this in their stride.
Well, I think, that what we've seen is that the oil flow through the Red Sea until now has been relatively unimpeded by these attacks. We've certainly seen the diversion of container ships to a very large extent. I think we've also seen the diversion of an awful lot of liquid natural gas carriers. And I would suggest that perhaps in terms of energy, the big commodity to watch is potentially liquefied natural gas rather than oil, or certainly has been up until now. But if we do start to see tankers diverted, what this means is that the journeys take longer. The oil continues to flow. There's no, at least so far, there's been no impact on the level of production or the level of exports. But what we are potentially going to see is that it takes longer from the oil to get where it comes out of the ground to the refinery that turns it into the fuels that we need. That could create its own bottlenecks. What it will mean, I think, is that if this happens, stockpiles in consuming countries will have to be run down for a period of time while these trade flows adjust.
Annika, are you more or less convinced that actually we'll go through some kind of soft landing or not an ugly recession worldwide?
Well, we're not too concerned about an ugly recession worldwide, simply because we've all been talking about this for 18 months. It's not happened. And one of the key reasons it's not, well, there's three main reasons it's not happened, but one of the most important ones is actually adaptability of people, adaptability of companies, change in behavior, whether it's companies doing labor hoarding, which means people are not being let go of, which means consumers are strong and wage inflation is there, whether it's consumers getting accustomed to very high inflation numbers. So we are not too concerned about the global recession fears. We're more into the stance of being very cautious and being very vigilant, especially around individual security selection, because as said, we are already at basically almost all-time high market levels.
Annika, what does that mean for where you want to be positioned? Again, I guess the biggest risk, we still don't really have a clear call or a clear path forward for China. What's the other big unknown for this year?
Yeah, so obviously China, that used to be, the big driver for global growth, is obviously abated. That's complicated. I mean, by far the bigger driver for this year from an index level is interest rates. As you say, everyone's extremely excited about the rate cuts that are coming. Talking about what we just discussed on oil, this especially complicates the European story. And as Lagarde has mentioned, as you just said, we are not going to see rates getting cut until we get closer to that 2% target. And the route to getting there is not going to be straightforward. We see all sorts of things emerge here and there. So are we too enthusiastic there? Could be. That's a major risk. But markets are going to be very, very driven by yields. And the speed at which yields are moving is astonishing. I mean, look at what happened November last year. That was the strongest move in yields since December 2008. And we know what happened then. So you've got to fasten your seatbelts a bit from that perspective.
And Julian, what can you tell us about how much China is consuming oil right now? And again, the dynamics through the China reopening, or how much the Chinese economy in 2024 will impact the price of oil?
Well, I think it will have a huge impact. I mean, we're already seeing that forecasts of global demand growth for 2024 are about half what they were for 2023. China is still a big part of that growth picture, such as it is. They've introduced very significant import quotas, but in a change from previous years, what they seem to have done is to issue these very large quotas at the start of the year and allow refiners the flexibility of when they take the oil. So that allows more flexibility on the part of the refiners, but also therefore creates less certainty for the sellers of crude. We've seen the Saudis make very big cuts in the price that they're asking for their crude for February delivery. And so that is, I think, a reflection of a softness of the physical market, which is in part a China story, and suggests that, you know, the Saudis are concerned that they have been losing market share in China and elsewhere to countries like Russia, Iran, and others, and they are looking to get that market back. But it doesn't suggest, at the moment at least, a particularly tight market in Asia.
Great, thank you so much. Our oil strategist, Julian Lee, and Annika Trian, Chief Economist at Van Lanschot Kempen, stays with us. Now, Reuters is also reporting that Tesla will suspend most car production at its factory near Berlin for 3 weeks from January 29th. And the moves stem from a lack of components due to shifts in transport routes because of the armed conflict in the Red Sea. Pre-market Tesla down 1.6%. Now, switching focus, Taiwanese voters also head to the polls tomorrow to elect a new president, choosing between closer ties with China or defending the island's autonomy. It's an election that really carries global implications for geopolitics, trade, and investment. So for more on this story, we're joined by Bloomberg's Chief North Asia correspondent, Stephen Engel in Taipei. Steve, Happy New Year. This is one of the most globally significant elections this year. So what exactly is at stake?
Absolutely. We just have a few hours left until, of course, tomorrow morning when the polls open. We've all circled January 13th on our calendars for quite some time, knowing that this was going to be such a consequential election because there will be a new president-elect, most likely, unless it's a real hung election, by tomorrow evening, because the incumbent president, Tsai Ing-wen of the more independence-minded DPP party, she is hitting her term limits. She will be stepping down, and her candidate is the vice president, Lai Ching-te. And again, if you want to look at the more conventional, more simplified, if you will, narratives, the DPP of the incumbent party is more independence-minded, and the opposition, the two opposition candidates, keep in mind this is a three-horse race this time. The opposition both say that the incumbent party is making Taiwan more unsafe because, again, that perception that they want independence. They've never declared independence. They have no plan to declare independence, but Beijing views the DPP, the incumbent party, as being a separatist. Now, on the other side, you have to look at the opposition. They want more closer ties with mainland China. They want to diffuse the tension, build the economic links with the mainland. But again, as voters go to the polls tomorrow morning, they are concerned as well. They want better economic ties for the most part, but they also don't want to essentially hand over their long, hard-fought freedoms and democracy and having a one country, two systems like plan down the road with China. They all saw what happened to Hong Kong and how that worked out.
Stephen, thank you so much. Stephen Engel there in Taipei. Now, coming up, we'll look at central banks. The ECB President Christine Lagarde says the central bank will start cutting rates, but only once it's convinced inflation is headed back to its 2% goal. That story is next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
March is probably too early in my estimation for a rate decline because I think we need to see some more evidence. I think the December CPI report just shows there's more work to do, and that work is going to take restrictive monetary policy.
I cannot give you a date, but if we win this battle, if we reach the 2% inflation target, as we predict in 2025, and if it's confirmed by the data in the months to come, if this goes according to plan, and I'm being careful the way I say it, but I'm very confident, then the rates will start going down as soon as the data confirms the inflation path.
Well, that was the ECB President, Christine Lagarde, and the Federal Reserve Bank of Cleveland President, Loretta Mester, giving an idea of where we can expect interest rate cuts. Now, still with us, Annika Trion, Chief Economist at Van Lanschot Kempen. Annika, we were talking a little bit before, of course, of some of this general pivot from central banks in 2024, some of the geopolitics. What does this mean for where you see the markets go? A lot will depend, of course, on yields and treasuries.
Absolutely. So, indeed, it's yields and treasuries, but yields are very dependent on what's going on with inflation, and whether or not this escalates or not will have a big impact on oil price, which has a big impact on inflation. So it's all quite circular, actually. And given how aggressively yields have moved in the last few months of last year, it's key. So the more information we have, the more doubts potentially we could have on the easing path of inflation.
Is there a danger that, as we saw towards the end of 2023, that the market thinks one thing despite central banks telling them something else? We've had mismatches right from the start, frankly, of COVID. And when do we go back to more, I guess, fundamental analysis of what we're seeing in the economy for markets to be driven by?
Definitely. It's a really good point, because from a central bank perspective, they have interest rates as their toolbox to manage inflation pricing pressure. Now, the bond markets are either following the cues of the central banks or they're doing their own thing. So if you see what's happened to yields and how aggressively the markets have priced in the U-turn, the big question is, have central banks lost control of the bond markets, or were the bond markets doing the work off the central banks? And let's make this very practical. And this is what Lagarde has really been pointing to even more than Powell at the Fed. the easing financial conditions that the yield market is showing us, is this going too far? Because if it's going too far, then central banks actually cannot get accommodative yet, because the financial markets have already done too much accommodation. And that is the biggest risk, especially if we see that inflation is not coming down as smoothly as we would have hoped, because, for example, geopolitical tensions.
Yeah. So are you negative on equities?
Well, we think we're not negative on equities per se. We are careful about equity valuations. I mean, look at the US, look at the S&P 500 and look at the valuations there and compare that to the risk return you would get in the bond market. And you would say, well, to be honest, why would I take any incremental units of risk and choose equities versus bonds if my return is not that much higher anyway? So that's obviously your equity risk premium. So in that sense, we are quite cautious. However, in terms of the underlying, again, look at the S&P 500, take away the Magnificent Seven, the valuation of the index is then quite different. So within the underlying, we do see opportunities. It's just that old school, roll your sleeves up, do your homework. What's the business? What are the end markets? How do we feel about that? Do they have pricing power? It's more of that stuff.
Annika, thank you so much for joining us. Annika Treon, their chief economist at Van Lanschot Kempen. Now, coming up, U.S. banks face a high-stakes reporting season after a pretty volatile year for the industry. So we'll preview those upcoming earnings next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So major U.S. lenders, including J.P. Morgan and Wells Fargo, are set to kick off earnings season today following a pretty volatile year for the banking industry, where I'm delighted to be joined by Jennifer Serrain, who leads our coverage of finance in the UK and the Middle East. Jenny, so good to speak to you. So first of all, I mean, we love earnings season because we get to understand exactly where the weaknesses are, where the strengths are. So what are we expecting these banks to say about investment banking and trading?
Yeah, you know, for much of last year, these banks were really talking about the revival is coming, the revival is coming. We really never saw that materialize. So deal making, capital markets are pretty much still on their back foot. And a lot of these corporate CEOs, you know, what they were saying is it's just too much volatility. We don't know what these central banks are doing. We want to stay on the sidelines. And so that's, you know, too much volatility for the corporates, but then not quite enough for the trading desk. So, you know, we've already had a lot of these banks come out and say the fourth quarter was tough. We think trading revenue is going to be down. So I think on the Wall Street front, we're really going to see, you know, quite a bit of a slowdown there.
So what are you expecting them to tell us about the health of the U.S. consumer?
Yeah, so I think that would be really what a lot of these investors are looking for today, because these are, you know, 4 of the biggest U.S. banks who have huge operations, both in terms of branches and credit cards. And really, so far, what we've seen from these guys is that the U.S. consumer has held up. So despite the fact that a lot of these folks were at the beginning of last year thinking that we were heading into a recession, consumers kept up with their bills. They're making their mortgages. They're paying off their credit cards. But we are expecting them to set aside a lot more in provisions. And so that's sort of a sign that, you know, while all is good right now, there could be, you know, dark clouds on the horizon.
And Jenny, I mean, I think this is huge because actually yesterday we had this like Fed study from, I think, the Federal Reserve Bank of Philadelphia saying that credit card delinquencies were going up. So if you look at the banks, is there one bank in particular that will give us a better indication of where we could see stress?
It's a really good question. I mean, I think JP Morgan is your go-to for all things credit cards. They're the largest in the U.S. Citigroup is kind of interesting because they do still have credit card operations in some international markets. And so you'll start to see, you know, is there a divergence between how the U.S. consumer is holding up versus how consumers in Mexico are holding up? So I think it'll be good to kind of keep an eye on, honestly, all 4 of the big banks. We've got a kind of a calm before the storm right now before, you know, 4 of the biggest U.S. banks tell us exactly where the economy stands. So.
All right. Thank you so much, Jennifer. I mean, it's good, right? You don't sleep for like 4 days as you follow the earnings, but it's interesting because it gives us a bit more of an indication on the U.S. economy. Jennifer Serrain there. Now, coming up, we'll bring you, of course, much more on artificial intelligence. Some misinformation and unethical practice by artificial intelligence rises up in the agenda of Davos next week. We'll be an exclusive conversation with the chief executive of Single Store. So you don't want to miss that. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support because we are the best investment cases for this in the world.
names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Houthi militants vow to expand their response to U.S. and U.K. strikes on targets in Yemen. Oil prices rise on fears of a widening conflict. ECB President Christine Lagarde says central bank will start cutting rates, but only once it's convinced inflation is headed back to its 2% goal. Plus, recession risks linger in the U.K. despite a modest rebound in growth in November. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. A busy Friday. Happy Friday, everyone. Now, rebuilding trust is next week's theme at the World Economic Forum. High on the agenda, of course, will be discussions on artificial intelligence. The technology has experienced a huge surge in interest, with the likes of Meta and Google prioritizing it on their platforms. But as business leaders and top officials gather next week in Davos, the potential dangers of AI are being considered on an unprecedented level. Well, joining us now is Raj Varma. He is the Chief Executive Officer of Single Store, a leading voice in ethical AI practice and enhancement. So, Raj, thank you so much for coming back on with us. When you look at AI, the debate has certainly shifted in the last 6-7 months. I know the UK is also trying to be a linchpin of AI regulation. Unclear where we end up with AI. Again, are we over-expecting AI to take over? Will it be quicker or slower than we think?
I do think it's going to be quicker than slower, if I was to take one position. I do think that people cannot celebrate something that they quite don't understand just yet. And I think one of the best explanations that I got about AI and the impact of AI was that the easy would get automated, the hard would get easier, and the impossible will become possible, right? And each of these things has an impact. You know, the easy becoming automated is going to have the job discussion.
Yeah.
The hard becoming easier will just have the opportunity conversation. And the impossible becoming possible will have the innovation, conversation. So there are different conversations. And I think all of that has to be encapsulated in the regulation conversation, because no one wants the negative effects to be exaggerated, I suppose.
But, Raj, I guess when we talk about unethical AI, is this state-sponsored AI for fake news? I mean, we're going through a massive election year. I mean, over 50% of world GDP will go to the polls. I mean, do you worry about interference in elections with the use of AI?
I do. I think that's a real threat. I think the information that gets fed to people and not knowing whether it's from a trusted source or not is a real fear. I think everything that we are hearing about deep fake, etc., is actually true. And I do think that 2024 is going to be one such year where the impact of unethical use of AI could be one of the biggest. And it could also have its resonance for decades to come, if not done right. If you get my drift, so yeah.
But I guess the concern, and you're trying to basically get companies to embrace ethical AI.
Yes.
And I don't know whether that's wishful thinking, because it'd only be the good companies that would embrace it, and then you'd also have malefactors.
Yeah, I think Francine, the challenge that you have is if you democratize anything, right, any technology for the most part, then you're going to have bad actors for sure. But in the vast majority of the use of AI and the democratization of AI, it's going to be for the good, right? A vast majority, 90% plus. the bad actors would be there. And I do think that when you're talking about 2024, I do think that the main media, the trusted sources, the Bloombergs of the world, will play a greater role, because I think a lot of people would be looking up to these trusted sources for their information. And us being upfront and saying that, please, your news is your personal responsibility, right? The sources of your news, and only go for the ones that you trust is one such thing that we are going to hear more and more about in 2024 for sure.
So one of the things I know that you also put the spotlight on is the use of data, right? The fact that this needs to be done in an ethical way. I mean, do you think it's possible for companies to self-regulate it? There's so many concerns about the big social media companies. The fact that if you don't have an external regulator saying, wait, hold on a second, you can't do that, that, and that, then it's a little bit lawless.
I completely agree. I do think that ultimately the three pillars of AI are information, context, and choice, right? The information is driven from your data set in an organization. The context, again, the LLMs and all the rest of it, and the RAG theorems that we are talking about. However, the choice is a organization's choice, which is directly correlated to the value system of that organization. We've seen many instances where the value system has been the age-old value system that the business of every business is profit. And if that continues to be the mantra that organizations use, then we are there for a tough ride, and AI is going to make it worse. But if the value system is do right, then I think AI can be the biggest, advancement in technology that the world has ever seen, Francie.
I guess the problem is, how do you define do right?
Yeah, that's right. I think fundamentally most leaders know what right is. Most boards know what right is versus what wrong is. Do they have the courage to stick to that right? Is what's going to be demonstrated in spades this year and in the next decade or so. And I do think that having the courage to do the right thing when the alternative is a lot easier and more popular is what's going to define good leaders versus not so good. So.
Raj, when I speak to a lot of chief executives, I think that their main concern is actually they don't 100% understand what AI will become. And so it's very difficult, even if you want to be ethical and do good, to understand the consequences of an action now, 3, 4, 5 years down the line. So who do you turn to try and understand? Is there like, godfather of AI that you think really understands how this evolves?
Yeah, I think there is no compression algorithm for experience, as they say. So I do think that we are all learning, being cognizant of the fact that we do not know what the context or impact can be. I think one of the CEOs I was talking to is, it's better to be, careful than sorry. So it's better to be slightly, cautionary in the use of AI now, because we don't quite understand the impact that it might have in the years to come. So the balance between caution and innovation will be something that we are going to have the leaders grapple with for sure, Francine. It's a real challenge.
There was a big scandal in the UK, which is still ongoing, with the post office and the fact that there was a software that was erroneous, but actually through many years, decades actually, the government decided to choose the software, the technology, over people. And there was a great piece by Adrian Woolridge in saying, this is going to be exacerbated because of AI. Is there a way of having AI but still putting humans at the forefront?
I think human in the loop is something that for decisions like that, for sure, I think human in the loop is the way forward. I think if you just automate it and let software, so as to speak, decide.
But can you keep control of it, I guess?
You can. However, I do think that keeping control in that moment of truth becomes the challenge, right? Sometimes you can only act after some action has been taken, and then you realize it's a bad action. Having human in the loop is equivalent of the 5-second delay that you have in your, programming, so that if something does go wrong, you can correct it. And that's the human in the loop concept that I think is going to exist with AI for at least a few more years. And I think you being able to take the person out or the human out of the loop will have to be a concerted effort in an organization, for sure.
Raj, thank you so much for joining us. I'm looking forward to actually seeing you in Davos. How do you prepare for Davos? Snow boots.
Snow boots, a lot of electrolytes and
coffee, strong coffee.
So yeah, it's snow boots for sure.
Thank you so much. The chief executive there, Single Store, Raj Verma, joining us today on AI and ethical AI. Now, coming up, after the police arrest two former Polish ruling party officials at the presidential palace, we speak to the mayor of Warsaw on the country's ongoing constitutional crisis. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, 3 months after Donald Tusk's pro-European alliance won elections in Poland, the country is facing a political crisis. Tusk's push to dismantle 8 years of nationalist rule in the EU's sixth largest economy is already an uphill struggle. And tensions are high between the new government and President Duda, who is wielding veto power over legislation. Well, joining us now for an exclusive conversation is Rafał Trzaskowski, the mayor of Warsaw and a senior figure, of course, in Poland's governing coalition. So, Mayor, thank you so much for joining us. How much do the events in recent days actually show the challenges that the government is facing?
Well, the challenges are huge, and we knew that it's not going to be easy and it's going to be an uphill struggle because the populists in Poland, now in opposition, are still strong. And of course, there is the president, the guy who comes from the populist party, who wields the power of veto and who tries to make our life difficult. But we are very much determined to bring democracy back in Poland.
But how difficult will it be for the Prime Minister to actually try and push through the necessary reforms to unlock the money needed that would be given by the EU?
Well, we do have a majority. We do have a functioning government, and we've started negotiating with the European Commission, and the European Commission, seeing that now the rule of law will be reinstated in Poland, decided to free up some of the money coming from the recovery fund. So that's underway. But of course, some of the reforms need to be put firmly into the Polish political system and legal system. And the president announced that he will veto some of the measures. So, of course, we are very much determined, for example, to make the public broadcaster independent again and to reinstate some of the changes that are going to entrench the rule of law and the Polish political system yet back again. But some of these measures will be difficult, and that's why the coming elections, first the regional ones, then the European ones, and then the presidential ones in 2025 will be absolutely crucial and instrumental if we are to really bring democracy back into Poland and make sure that it's not going to be weakened by the president or by the populist opposition.
And Mayor, you mentioned their state media, one of the reforms that you're trying to do there, which you also mentioned has, taken some protest from the Law and Justice party. So how do you respond, for example, to the allegations that the process that you're looking at just doesn't have enough transparency?
Well, it is pretty transparent because it is the Ministry of Culture, which is an owner of the public broadcaster, and these changes have been reinstated, and that's why we have free public media yet again in Poland, which are transparent and which are independent and which inform about both sides of the political aisle and present different opinions. But of course, for these changes to be clearly reinstated, we need some more legal changes, and yes, there is a certain danger that the president will veto some of them.
So there hasn't been that much market reaction so far. Do you worry that actually investors look at Poland and start pulling back some of the investment because of the political uncertainty?
No, I don't think so, because there is a clear majority, and of course we knew that the opposition will be vocal, but we all know that these guys are populists who have been undermining Polish democracy for the past 8 years, and Poland is stable. Yes, there are some problems, of course. There is a certain amount of chaos that it's being fueled by the populist opposition. But we are determined these changes will be carried out, and hopefully we are going to win the next elections, which is going to entrench democracy in Poland even further. So I don't think that there is any reason to worry. And I think that all the investors who closely follow and scrutinize the situation in Poland know that there is no need to really worry.
So broadly, and again, I know we've gone through some of the more contentious points, but what are your 3 priorities to get the job done?
Well, the most important priority is, of course, the public media, because we cannot agree for a situation in which public media is used as a blunt tool of propaganda, as it was for the past 8 years, and that has largely been done. Now it has to simply be entrenched. Then, of course, the rule of law, and we're working on it. But as I've said, we will need also the president to agree for some of the changes, and we are ready to negotiate them. And thirdly, to bring Poland back to the high table at the European Union and in NATO. And of course, with Donald Tusk, with his incredible popularity, with his knowledge of the European institutions, that's underway. And here, I hope that the president will cooperate with us, because when it comes to foreign policy, when it comes to European policy, when it comes to, for example, our stance on what's happened in Ukraine, on that we are on the same page with the president.
All right, thank you so much, Mayor Rafał Trzaskowski there. He's a mayor of Warsaw, and of course, a senior figure in Poland's governing coalition. Coming up, we'll talk about luxury. Burberry's hit with the January blues after sales declined in its key Christmas season. So what does it mean for the wider luxury sector? That's next, and this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Now, the world's largest listed hedge fund manager, Man Group, has a woman in charge for the first time in 240 years of history. On the next episode of Leaders with Lacroix, I speak to the chief executive, Robin Grew, about diversity and breaking down barriers in finance.
I am hopeful that we're going to see a better reflection of difference at the top of every organisation, be it financial services or broader than that. Has it been a long time coming? I can't help but say, listen, it would be terrific. It would be good to see more female CEOs before me. I hope we're going to see a lot after me. But difference is important, and I think anything that enables us to put the most talented people at the top of organisations and to lead those organisations with enthusiasm and capability is what we're after. So I'm hopeful that I'm knocking down some doors, barriers, ceilings.
Now, I also spoke to Robin Grew about the outlook for the UK.
You're talking to a UK-listed CEO, so I could not be more interested in UK PLC. I think we have held such an extraordinary position in financial markets and generally, so anything we can do to keep that shine, I think, is important. But competition is high. And we shouldn't, in the way that we shouldn't in our firms, sit on our hands and think that all of our history is going to count for long if we don't keep running. So I'm a great believer that we drive and continue to drive UK PLC. There is such a lot of innovation and creativity and growth here. There's such a lot of expertise that sits in these small shores. So anything we can do to keep that alive and keep it at its top game, I'm all for. But we operate as a global organisation, and I'm going to go where there is strong capability to invest, where the markets are deeper, where the clients need us to be, and where we can find opportunity. And I'm going to continue to look for that. But I'm a UK-listed CEO who can't help but want this to be great too.
And you can see that full interview with the Man Group chief executive, Robin Grew, on Leaders with Lacroix. It airs tonight, 7 p.m. New York time, and then 1 p.m. London time tomorrow. Now, on to luxury, and Burberry slumped in the UK trading, or slumping in UK trading, after the trench coat maker recorded a drop in sales in the key Christmas quarter. Now, the luxury goods company has now slashed its profit forecast in an unscheduled trading update. Well, for more on all of this, let's go straight to our retail reporter, Dasha Afnasieva. Dasha, what have been the problem areas for Burberry?
Well, unfortunately, on the call, the CEO said that actually there was deceleration in all regions, but in particular, I think that the slowdown in travel retail in China has hit them. And I think for Burberry in particular, this is an ongoing story. So they're already launching a turnaround. They had a new creative director, Daniel Lee, who unfortunately for him, it's very unlucky. He joined just as there's this global slowdown in luxury. And now Burberry has got to convince the market that its turnaround is going to work, that it's going to also convince consumers to pay more for its collections, despite this massive slowdown in the run-up to Christmas.
But Dasha, I guess the concern is this Burberry, or is this just luxury stocks in general that will be, down hit because they've done so well in the last 18 months or so?
I would say it's a mixture. So today, LVMH and other luxury stocks sold down a little bit. In particular, LVMH doesn't have exactly the same kind of problem as Burberry because obviously it has lots of brands, so it can switch its marketing resources to different brands depending on what's working at the time. But I do think it's fair to say that there is a bit of a luxury slowdown. It's arguably, you could argue that it's the cost of living crisis or it's the long-term post-COVID effects and rebalancing. And people running out of their savings that they had accumulated during the pandemic. But you can see it, for example, in drink stocks, particularly Remy Martin and, the drinks division of LVMH has suffered because they sell these incredibly expensive bottles and have staked their strategy on convincing consumers to pay more and more per bottle. So I think it's a mixture.
Dasha, overall, are there any, there's LVMH, there's Kering, there's so many of these big luxury conglomerates or companies. Who do you think will come out on top, and where are we seeing the real troubles?
Well, I think it's really hard to say, but at this stage. But having a conglomerate is obviously an advantage, and having less of an exposure to China and Chinese retail, which is tricky for the luxury sector because it's been so driven by Chinese demand. I think those are all advantages. I think in Burberry's case in particular, it's now trading around 2016 levels. So you do have to wonder at what point does it become a takeover target. But on the other hand, the market cap was £4.5 billion. So whoever would be interested would have to really believe in this heritage British aesthetic that Burberry's known for.
Dasha, thank you so much, as always. Dasha Afanaseva there on luxury. Now, all of next week will be live from the World Economic Forum in Davos. We'll bring you interviews and discussions with some great interviews. This is Bloomberg.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range, because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Houthi militants vowed to expand their response to the U.S. and U.K. strikes on targets in Yemen. Oil rises on the fear of a widening conflict. U.S. inflation picks up, putting the rate cut hopes in peril.
I think March is probably too early in my estimation for a rate decline, because I think we need to see some more evidence. I think the December CPI report just shows there's more work to do, and that work is going to take restrictive monetary policy.
And bank stocks are setting a high-stakes earnings showdown. JP Morgan, Bank of America, and Citi, Wells Fargo all kick off their results today. What are markets listening to? Probably the short end of the curve. Danny and I were discussing this morning. Equity markets are desperate not to listen to the Federal Reserve. So you got S&P 500 just dipping into the red this morning. Yes, there was a bit of activity under the hood. You had the Bitcoin ETF trading $4.6 billion worth. It was a groundbreaking day. Grayscale saw perhaps the most flow through, $2.3 billion. But maybe it is that dip in the short end. Danny will take you through that bond market in just a moment. In terms of Europe, it belies a very, very interesting story. It's up 0.75%. A little bit of that is going to be the oil stocks on the fact that oil is bid on the escalation in the Middle East. But what you have is Burberry shattering dreams, really, in terms of the guidance for them. They've tried to rejuvenate that stock on several occasions. But again, the guidance from Burberry is underwhelming on the operating profit. The stock down 7.3%. It was down double digit at one juncture. I put the Nikkei on the board because I think it's relevant. In the end of the day, what you've got is a differential between trying to hold back the rate cuts by Mester and Barkin versus Lagarde, who is talking about rate cuts. And indeed, now the market is pricing in 6 rate cuts again in Europe rather than the 5. Nikkei is up 1.5%. That's the biggest weekly rally in 2 years. And of course, fast retailing, they own Uniqlo. It's a brand well known here in the US and in Europe. That rallied again to a new record high. Danny.
Manus, it is the risk of geopolitics that's front and center today. Oil prices are up by more than 2%, almost 3% this morning. But let's be clear, the premium that's built in here, the war risk premium, after U.S. and its allies struck airstrikes against the Houthi rebels, we're still below where oil was in October. This is a minuscule risk premium. ING says to see some real action in prices, you would need to see Persian Gulf supply disrupted. Elsewhere, Manus, you mentioned this, the maddening reaction from markets after yesterday's CPI. comes in hotter than expected. You also have Mester, you heard it there, saying that there's no case to cut in March. Yet the front end, sure, it's higher this morning. We're selling off a little bit, but yesterday it rallied. Yields fell by 11 basis points. It is a head scratcher. Finally, Bitcoin, even though grayscale benefited hugely, as you pointed out, the price of Bitcoin, Manus, didn't really move very much. We're still under 46,000. Perhaps that is just because all the historic money that flew into ETFs is really just seed money. In other words, pre-planned money. But to get back to the geopolitical risk, Manus, even though oil prices are not moving as much as you might expect, the thing that clearly has moved is shipping prices. Shipping rates have spiked. They have doubled. We have this chart for you. They have doubled since November. And the threat is that with now U.S. and its allies launching airstrikes in the region, Manus, that this is just going to get worse as we have to divert ships away from the region. There you go. There's the shipping prices, again, doubling since where they were in September.
Yeah, look, the debate is what is the scale of war premium? What is it that triggered the US and the UK actually to launch missiles? That's the issue, Danny, isn't it? I mean, if you look at the war premium, geopolitical premium, according to Citi, is $2 to $3. If you look at Standard Chartered, they're saying it's $10. If you look at Rapid, Bob McNally was with you and I last week, and he was saying it's $12. So again, this market is awash with oil. That is the supply side. That is the issue. Let's talk about the US and the UK launching more than 60 airstrikes, Danny, on these Houthi targets in Yemen. The response in the Red Sea. President Biden is backing that response. The US and our partners, he says, will not tolerate attacks on our personnel or allow hostile actors to imperil freedom to navigate in one of the world's most critical commercial routes, along with the Prime Minister, Rishi Sunak, stating this from the UK side. It will always stand up for freedom of navigation and free flow of trade. We have therefore taken limited, necessary and proportionate action in self-defense. Mark Champion joins Danny and I this morning. It's interesting, it's the UK and the US that launched the missiles. The others in the coalition acted as support role. It's not going to deter the Houthis, certainly not from their rhetoric, is it? Good morning, Mark.
Good morning. Yes, I mean, this was in a sense inevitable. You know, as the Houthis had become more and more bold, the US and in particular had laid down red lines, set out warnings, didn't have any impact. So, you know, politically, this was always going to happen. Very difficult not to do that for President Biden. And then also just in terms of the kind of signaling that you send to Iran and so on, and what, you know, U.S. red lines will mean, whether that's in Lebanon to prevent Hezbollah from getting involved in the war in Gaza. So, you know, this was going to come, but you're absolutely right. The Houthis are, you know, it's very unlikely that the Houthis, who've been very resilient against years of aerial attack by Saudi Arabia and the United Arab Emirates, will suddenly lose all of their capacity to attack, or that they will lose their will, because this is essentially they're getting what they wanted when they got involved here. Their status is improved. They may not be that unhappy that the U.S. they're now being attacked by the Great Satan. You can see from the responses from some other Iranian allies like Hezbollah, where they say that this just proves, the case.
What does that mean now that we have this response from Iran of further escalation risk? Where are we on that?
Well, I think that remains relatively limited, that neither Iran nor Hezbollah nor the U.S. Actually want a wider war across the Middle East. And so, you know, I think the Iranians and the Houthis are getting what they wanted.
Okay, Mark, thank you very much for joining on this. That is Bloomberg's Mark Champion. Now, to another side of this story, the airstrikes have caused oil to jump as investors try to measure the chance of an escalation of this conflict. Joining us now is Bloomberg's Will Kennedy. So, Will, I mean, yes, we're higher, 3%, but still lower than we were in October. What is the bar then for this market to really price in some more premium?
Well, as Manus alluded to earlier, and as some analysts have been saying, is that if you wanted to see a real movement higher, you're probably going to have this spread to the Straits of Hormuz, to the Persian Gulf, and for the exports from the main oil-producing exporting nations in the region, the UAE, Iraq, Saudi Arabia, to be disrupted, and they haven't been yet. However, it is quite a decent move this morning, and I think there are two big risks here. One is that the Houthis escalate in response to this attack. So far, their attacks have really been aimed at container shipping, and we saw the spikes in container rates that you mentioned earlier. They haven't attacked oil tankers. If that were to change, that would be a risk for the oil market. It would drive freight rates higher and thus the price of oil as it's delivered. I think the second big risk here is that the action in that region makes the Red Sea even less navigable for the short term for the global fleet. We've seen the military warn commercial shipping to be cautious about going to that area this morning. So far, it looks like people still are, but there is a risk if this continues to escalate that the Red Sea effectively closes, and again, then that will have an impact on oil trades and oil wagons. So there are risks here. I don't think we should be complacent, and I think that's reflected in today's move back towards $80 on Brent. But as Manna said, the world is well supplied, and that's not changing in the short term because of this.
Yeah, we're seeing note after note come out from the various houses downgrading their outlook for prices, and it is predicated on supply. We probably need to shift our attention geographically as well from the north of the Red Sea, perhaps a little bit further south. If Iran really does enter this conflict, how will that change things? I mean, yesterday one could say Iran capturing the oil tanker off the coast of Oman was, to some extent, we don't know the triggering reason for the action, but that certainly is a major escalation by Iran, isn't it?
Yeah, I mean, when we see these tensions in the Middle East, when we see tensions between Iran and the US and its allies rise, focus always turns to the Strait of Hormuz, where exports from some of the world's largest exporters all have to travel through. It's very narrow. Iran controls it. And yes, that is a concern for the oil market. I would just caution that Iran has never really acted to close the Straits of Hormuz. It's something that it's never, in recent times at least, done, because I think they realize it would be such an escalatory measure that it would have to see an enormous response. So yes, it's always a risk for the oil market, something people are aware of, but I don't think there's any sense that that's going to happen in the short term at least.
Okay, words of caution there. Will Kennedy, let's stay on the case. Will Kennedy, head of commodities for us in London. To the top trending stories on the Bloomberg terminal this Friday morning. Reuters reports that Tesla will suspend most car production at its factory near Berlin for 3 weeks from January 29th. The move stems from a lack of components due to the shifts in transport routes because of the armed conflict in the Red Sea. Danny.
China's consumer prices mark their longest streak of decline since 2009, extending the deflation that may require more government support to reverse. Exports Manus posted their first annual decline in 7 years.
And the ECB President Christine Lagarde is warning that Donald Trump's first term as president raises concern about his potential to return to power in 2025.
If we should learn lessons from history, from the way he led the first 4 years of his mandate, it's clearly a threat. It's sufficient to look at the trade tariffs, the commitment to NATO, the fight against climate change. In the three areas in the past, US interests were not aligned with European interests.
Coming up, we're counting down to US PPI data this morning. After that sticky CPI, we'll look ahead with Alfonso Peccatiello, CEO of the Macro Compass.
And lest you forgot, it's Banks Day. Earnings kick off this morning. We're going to discuss with an investor of many banks, Walter Todd of Greenwood Capital, later in the hour here on Bloomberg Brief.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears. Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. So, Manus, we had a hotter than expected CPI yesterday. Here's another risk when it comes to inflation. Cost pressures are mounting alongside the tensions in the Red Sea. So here you're looking at shipping costs. They have soared in the first 2 weeks of this year. They basically have doubled since December. Let's now bring in Alfonso Pecatiello. He's the founder and CEO of the Macro Compass. Alfonso, already this is a market that barely responded to CPI. I should correct that. They did respond, but not in the way you might think. They responded in a way that suggests the Fed will cut more. Are we now also overlooking the odds that this geopolitical tension adds to inflation?
So I would say the first thing is markets should have been spooked by yesterday. I don't really agree. If you translate the core CPI number into the real Fed target, which is core PCE, yesterday numbers were equivalent to a month-on-month increase of 0.2%. 0.2% means the 6-month trend in core PCE is going to move from 1.9% to 2%. So I'm not sure whether markets should be spooked by that, because the Federal Reserve ultimately targets PCE and in particular core PCE. And if you translate the measures for the last 3 months, we have been annualizing at 2.3, 1.9, and now 2%. So honestly, I don't see yet the reason why markets should freak out. Actually, you can say that with job market producing about 115,000 private jobs a month on average, and core inflation annualizing around 2% for 3 months in a row, markets should be pretty happy here. Although we should look at risks forward, you're right.
But you say, good morning, Alfonso, you say is that they should actually get on with the job because real rates are too high. Given the numbers that you've just laid out there, you say real rates need to be squeezed lower. So what went through my mind when I read that was well, the natural corollary to that is, are we in the foothills of another policy mistake, which is you're telling me one thing, the market, they're telling me another thing, and you're saying real rates are too high, but they're trying to hold us back from the 6 rate cuts that we got priced in. So are we in policy mistake already?
So I would say what the Federal Reserve is trying to do here is to risk manage. So they're saying real Fed funds, nominal Fed funds are 5.25, and the annualized level of core PCE is about 2%. So that means real Fed funds today are north of 3% positive. They're pretty high. So what they want to do is to normalize policy. That means moving policy back to neutral over time. It doesn't mean you have to rush into it, but that you gradually have to ease monetary policy as nominal growth slows down over time. So that's what they're trying to do. If you look at markets today, markets are pricing as the mean outcome 6 cuts. But if you look at the distribution of rate cuts, you will see that the most observed outcome in the option market is actually 2 to 3 cuts. And then there is a fat recession tail, which is still there, sits there because people are afraid of this policy mistake, and this fat recession tail is moving the mean pricing we see on the screen towards 6. But options are telling us the most weighted outcomes by option trader is actually 2 to 3 cuts. So the bond market is pretty rational here, and the Federal Reserve, I think, so far is trying to maneuver these slow cuts that accompany a slowdown in nominal growth. The problem here is that, of course, the macro lags kick in from previous tightening, so this equilibrium is pretty delicate as we move on.
Alfonso, I have an extremely nitpicking and I should say self-serving question because I'm going to have to join Manus in looking for a place to live in New York. And the shelter component of inflation has been so stubborn. I mean, it's maddening that rental inflation isn't falling. I know it operates on a 12-month lag, but we've already kind of gotten past that normal lag period. What's going on here?
She's worried.
So basically this idea that you can just... Basically this idea that you can just plot the Zillow rent index or any other actual on-the-ground rent series and then say, with 12 months lag, it will one-on-one translate into housing CPI, I think that's a bit naive. So there are some complications based on the fact that Zillow rent, for example, is a series built on a different composition of rents between, for example, single-family or multifamily rents than the actual CPI rent of shelter series is built on. So it's not that simple, yet I think the slowdown is happening, but it's a bit slower than expected. So this is one of the risks, Danny, and I think you're right from that perspective, that that slowdown happens a bit slower than people expect. And the other risks that you guys are highlighting, and it's correct, is that core goods so far are printing pretty much in line with pre-pandemic. So it's almost like a deflationary environment for core goods. But if you have supply chain disruptions, that's going to stop. So what my point here is the following. For the next 2 to 3 months, we are still in that environment where if you look at core PCE, we're annualizing at 2%. And honestly, 2% is great. And the labor market is printing numbers that are weak, but not recessionary yet. Yeah. So we're looking at pretty much a job done situation for the next 2 to 3 months. And markets should thrive in that environment. But we should bear in mind the risks looking forward of an acceleration of inflation perhaps in the second half of the year and position portfolios thinking about potential convexities and risk management in this environment.
Well, first of all, you get a gold star for actually coming on the show and helping disaggregate the differential between WERP and our obsession with 6 rate cuts and what the options market is actually pricing. So thank you very much. You finally delivered real clarity to the differentiation. Gold star for you. But then thankfully, nobody's depending on my advice anymore, so this is a great relief. People are depending on your advice. So therefore, given that risk narrative that you've just put out, do you want to be hellishly bullish on equities, and do you want to be long of bonds to your tonsils?
So basically, the bond situation manager is a bit tricky because what you would want to do is not necessarily buy that recession tail, which is embedded in the pricing today. You would want to go towards the body of the distribution. You would want to say, hey, the risk of higher for longer is a bit overestimated. The risk of a recession is a bit overestimated right now. For the next 3 months, we might go just in the middle of that distribution. This reminds me a lot of the second half of the second quarter of 2019. Mm-hmm. Second quarter of 2019 is a period where inflation was controllably going down to 2%. The labor market was weak, but not recessionary. Powell had verbally pivoted. A few months later, the Fed would actually cut rates in July 2019. This period actually resembles that. And if you look at market returns in the second quarter of 2019, you find that the stock market did pretty well back then.
Okay, well, hopefully I'll get the fully invested pension fund in there before it all turns. Danny's with me. She'll get cheaper rent. I'll get invested for pensions. Hurrah for us. Alfonso, thank you very much. Alfonso Peccatiello, breaking down your work function on Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
DOJ or other authorities.
Could face bigger challenges next.
That was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger alongside me in London. Have you got a Burberry trench coat? That's the starting point for this conversation.
Answer's no.
Neither have I. But I did see somebody wear one the other day, and they must have paid up for it. Burberry warns. Danny, they already set out their stall at the back end of last year saying it was going to be tough. Today, they tell us they're slashing the operating profit target for £410 million to £460 million for this quarter. So it's tough for Jonathan Ackroyd there at the moment. I mean, he's been trying to jumpstart this brand. I mean, the halcyon days seem to be behind this brand for now.
I mean, you have to feel kind of bad for their creative director, Daniel Lee. He was literally just appointed kind of at the timing of luxury overall having a downturn. And I just can't imagine being a fashion guy, probably really creative, and then having to hear like some UBS analyst is telling you that your creations aren't good and there's not enough hype on social media. I mean, maybe he doesn't listen to a UBS analyst, but
well, you're probably right. He probably doesn't. And that same analyst said, you know what, you want to be more defensive because it's about aspirational luxury. And the reason why I say have you got a trench coat, I think a trench coat is probably more than £1,000, but it is about that aspirational luxury. It's under pressure. The CEO's on the tape. He's got a couple of lines there, Danny. He's saying traffic in China is still soft. Initially, the slowdown with aspirational luxury. And this came through from Richemont. This came through from a number of them.
Yeah, actually, to that point, Goldman has just trimmed its 2024 global luxury forecast from 8% to 6%, and it's about China, but says that perhaps the Chinese consumer will improve in the second half of the year. Okay, Manus, we have more earnings to talk about. Banks on deck. We'll discuss with Walter Todd of Greenwood Capital.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Menace Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Houthi militants vow to expand their response to U.S. and U.K. strikes on targets in Yemen. Oil rises on fears of a widening conflict. U.S. inflation picks up, putting rate cut hopes in peril. Cleveland Fed President Loretta Mester says March is too early for a rate cut. And bank stocks are set for a high-stakes earnings showdown. J.P. Morgan, Bank of America, Citi, and Wells Fargo all kick off results today. So first to the geopolitical risk. Brent crude picking up significantly in the past 30 minutes, now up 3 1/3%. We are just nearing on $80 a barrel after those coordinated airstrikes from the U.S. allies in Yemen to the Houthi rebels. Still, depending on who you listen to, we have more to price in when it comes to the war risk premium. U.S. two-year yields, an odd reaction to a CPI that was hotter than expected. 11 basis points of decline for the two-year yield yesterday. We're up by 1, but if you listen to Alfonso Pecatiero, as we just did, he said, actually, it's a fine reaction, job done when it comes to inflation in the Fed. Finally, Bitcoin, Manus, you had the stat, $4.6 billion flowing into ETFs, but the price of Bitcoin, it just doesn't care. Perhaps a lot of that was seed money, in other words, very pre-planned money. So fundamentally, still no change. We're below $46,000.
Oh, let's get trashy. It's Friday. I mean, as you know, that's that awful, awful phrase of buy the rumor, sell the fact. Why not throw it in there? Everybody else has. You're right. The conversation we've just had with Alfonso, I think, defines very much where risk is, that real rates are too high. The job is done on inflation. In actual fact, the market, whilst work function shows you 6 rate cuts, the actual real concentration in the option markets is 2 to 3 cuts. At the moment, you've got a dichotomy going on. You've got Christine Lagarde talking about rate cuts. She won't tell you the timing on them. She just says when the job is done, we'll talk about rate cuts, versus Loretta Mester and Barkin, who are trying to restrain the U.S. market on the sequence of cuts. You're right, Grayscale is bid up on the back of the flow show yesterday with them. You've got the Lagarde narrative this morning driving European stocks higher in part. We're now looking for 6 rate cuts as opposed to 5 rate cuts. After she spoke, the market shifted its pricing. Burberry is taking a bath. We've just spoken about that at length, Danny. That's about the guidance on the operating profit. It's about aspirational luxury. We, the aspirants, apparently not spending enough on luxury. And the Nikkei up 1.5%. What you've got there is, again, a lovely run on Japanese stocks. This is the biggest rally in 2 years. There's a flow show out of China into Japan. That seems to be the building consensus narrative. Danny.
Manus, I'm still working on our pitch to take Bloomberg Brief on the road to Tokyo. I think we do a really good job.
I think we do a fantastic job. And dollar yen, I love it. What's not to love about me going to Japan?
Corporate should love it. It'd be so cheap. It'd be so cheap, cheaper than having us in New York. But Manus, on the point of cuts expected, some of the flows that we're seeing, Bank of America's out with their weekly note. Cash has had the strongest start to a year on record. And Michael Hartnett says that with some of the moves we've seen, investors are still underpricing the risk of a resurgence of inflation because of the geopolitics.
I'm one of those spectacularly singular moments. I think the only thing I can remember from it, having flicked across it, is the $7 billion went into equities. But again, the takeaway there is the money is still going into cash. Danny.
Yeah, exactly. Well, now we have to get through bank earnings. And before we can get through bank earnings, there's some drama on the individual front. HSBC now facing a $1 billion lawsuit after hiring bankers from SVB after its acquisition by First Citizens, alleged it was stealing trade secrets. Joining us now on this and the banks is Bloomberg Charlie Wells. So where does this leave HSBC and First Citizens, Charlie? We thought the saga was over. It's not over.
Well, yes. I mean, it leaves both banks kind of grappling with that well-known fact that financial crises may end, but that's kind of when the litigation starts, and it can drag on, if we think about the financial crisis, for decades. But looking at both sides here, I mean, HSBC, they're not going to be happy about this. So this was a decision from a federal magistrate's court in San Francisco this week, basically saying that this lawsuit cannot be dismissed. HSBC wanted this all to go away. It is going to proceed. Basically, First Citizens alleges that HSBC and a former employee of Silicon Valley Bank came up with something called Project Colony. Now, in that project, they attempted to poach 42 Silicon Valley Bank employees and steal trade secrets. And we need to remember that First Citizens, 2 weeks after Silicon Valley Bank last year went into administration, First Citizens acquired Silicon Valley Bank. Now, HSBC said that it did nothing unlawful. It says that the employment agreement between Silicon Valley Bank, these employees, and the acquisition of First Citizens, that those were not connected. But look, First Citizens is not going to have an easy ride here either. Federal Judge Laurel Beeler this week said that First Citizens is going to need to clean up and clarify who at HSBC and what other defendants, what role they played here.
Who would have thought that banking could be so exciting in terms of the story? Charlie, good to see you this morning. I mean, banks got a great big bid up, didn't they, in the last hurrah of risk of 2023, up 20-odd%, 23% on the KBW. The curtain goes up today. JP Morgan, can anybody catch them up? You know, what is it that the market is going to be most focused on? We've got JP Morgan, Bank of America, Citi, and Wells Fargo today.
It's really going to be all about rates, especially after those share price rides, last year that you were just talking about. And I mean, look, JP Morgan really in kind of a league of its own here. It ended one of the most dramatic years in recent American banking history, bigger and stronger than it was before. Analysts are expecting, $3.62 in earnings per share. That share price compared to last year is up 22%. And we have been reporting on how JP Morgan is set to have the most profitable year in American banking history. But look, there's going to be a lot of other interesting news coming out today, too. I think people are really going to be focused on Citigroup. We've been talking so much about Jane Fraser's reorg there. I think people are going to want to see if there's more clarity on that. But really, at the end of the day, it's rates as well. And people, given the kind of bumpy economic signals that we've been getting over the past few days, that CPI print comes to mind, people are going to want to see what the experts at these banks are thinking about the Fed's next moves in the year ahead.
Charlie, thank you very much. Let's see what the Don has to say himself. Citigroup done 0.7% pre-market. Charlie Wells on the look ahead. Let's take it to Walter Todd, President and CIO at Greenwood Capital, which owns shares in JP Morgan, Bank of America, Wells Fargo, and Morgan Stanley. A vested interest, one could say. Now, look, Walter, you say the rubber hits the road today in this earnings season. We're going to see what the narrative is. In fact, the reality. We're going to get a reality check from these companies. Danny and I were looking at credit card delinquencies. They're spiking higher. They're at a decade high. How much of a reality check are we going to get, or is it just going to be nirvana?
Well, good early morning and happy New Year to you. Yeah, so I think you mentioned credit card delinquencies, and that's certainly one area that will be a focus. But a reminder that those companies are making tremendous amounts of money. If you checked your interest rate on your credit card lately, I think the focus is going to be really on 4 areas when these banks report. It's going to be on the net interest margin, as was alluded to earlier. It's going to be on any type of reserves that they have, looking ahead. And this will be the first time that we really get a chance to hear from these CEOs about their outlook for 2024. And we got to have this dichotomy of the expectations for actual earnings for most of these banks outside of JP Morgan are low, down 25 to 30% in the quarter, but yet the stocks have run 35% from the lows in October. So the stock prices have elevated expectations while the earnings are fairly low.
Yeah, there you can see the credit card delinquencies that both you and Manus mentioned of jumping. Walter, I wonder then if the trade going into this earnings season, if there's any merit in doing almost a value trade within the banks, with JP Morgan as high as it is, with Citi as low as it is, and expectations from Mike Mayo that it's could double in the next 3 years. Is the trade sell JPM, buy Citi?
Yeah, that's one strategy. It's not the one that we're employing. JP Morgan is one of our core holdings within banking, and it has kind of been a stalwart. As you alluded to, it's massively outperformed its peers. But I do think it's kind of a core holding. Now, around that, to your point, you could look at alternatives that have lower expectations, and Citigroup is one of those. Bank of America is another one, and Wells Fargo, quite frankly, if you look at the valuation, is also low. But then when you move beyond that to some of these smaller regional banks, you see some value as well. So I think it's having a combination of the two, kind of that core holding of JP Morgan and a satellite around that of some cheaper banks with perhaps lower expectations. I mean, JP Morgan, as we've said before, is really kind of an industry unto itself. So it's not really a good read on the kind of the core banking system within the U.S. necessarily, even though it's the largest bank here in the States.
It's going to be tough. I mean, yesterday I had one guest that sort of pushed back against the capital buffers that these banks have and whether you're going to see a significant shift in capital payback, buybacks, and dividends. Where or how do you rank or differentiate this group when it comes to that? Because the capital buffer that JP Morgan has is fundamentally way ahead of everybody else.
Yeah, I mean, I get the sense that the kind of the buyback and dividend programs of these banks, because of the regulatory environment that we're in and what happened last year in 2022 with the bank failures, JP Morgan's, Jamie Dimon has been griping about this for a while, but I think it is going to constrain their ability to do, a lot of significant dividend increases and stock buybacks. So you have to take that into account. I do want to point out, though, that this BTFP program that was implemented on those bank failures has been a pretty good tailwind for these banks. They can actually borrow from that and put the money in Fed funds and actually make a spread. That's been a nice tailwind for a lot of banks for the past 9 months, but that program is set to end in March of this year. So that's going away, if you will.
Given that, Todd, especially of the regional banks, because I know you like a few of them, who is safe, who is still vulnerable?
Well, I think given what the Fed did from a liquidity standpoint and giving them that liquidity that they did with that program, I think the banking system in general is pretty sound. I still think as you go down the capitalization structure into the smaller banks, the real rub though is deposit flows, right? So they're still seeing deposit flows net out of these banks as rates remain elevated. As the Fed starts to cut, that will lessen, but that will be a real focus as we hear from other banks in the weeks ahead. What have they seen from a deposit flow standpoint and their net interest margin?
Okay, Walter, we got just about an hour until Bank of America reports and the others follow soon thereafter. So get what probably is like your, 6th cup of coffee this morning. We wish you luck for that. Walter Todd of Greenwood Capital, thanks for joining us. All right, Manus, a quick check on commodities. Brent crude has now hit $80 a barrel on the escalation of, or potential fear of escalation in the Middle East with U.S. airstrikes and from allies on Houthi rebels. Again, it's not quite as much premium, Manus, as we had heard from Rapidan, for example. They said $12 more should be priced in. We're now just about $3 higher.
Yeah, but I think that, you make a very good point on this. We looked at the freight rates and to what extent they are blowing up and blowing out. And we haven't seen moves like this in a couple of years. And therein lies the point. This is one of the most salient risks for the Fed, for the ECB, for all central banks, is that this does escalate and that those freight rates then come back in as a secondary round of inflation.
Yeah, no, it's very true. It's a risk perhaps we're overlooking. Okay, Manus, coming up, Taiwan goes to the polls this weekend. It's the world's first major democracy test in 2024. This is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. I'm Danny Berger in London. Manish Krani is in New York. Now, voters are heading to the polls in Taiwan tomorrow to elect a new president, choosing between closer ties with China or defending the island's autonomy. It's an election that carries global implications for geopolitics, trade, and investment. For more on this, let's bring in Bloomberg's chief North Asia correspondent, Stephen Engel, in a beautiful night in Taipei. So, Steve, I mentioned it there. What is the global implication of this election?
Well, it is huge, obviously. For the last 8 years, we have had the presidency of Tsai Ing-wen of the DPP, which tends to be more of an independence-minded policy. Beijing views Tsai Ing-wen and the DPP candidate, Lai Ching-te, the vice president of the president right now, as separatists. So we clearly know since the last election in 2020, things have changed in the global economy. We've had, obviously, Xi Jinping in Beijing consolidating his power. He has more autonomy over policy, and he has stated he wants to take Taiwan or bring Taiwan back into the Chinese fold, no matter however method is necessary, whether it's peaceful or possible military use. And having a separatist-minded president here obviously raises the stakes. We have also had, over the last 4 years, no doubt, the pandemic, which put some pressure on supply chains. You've also had, of course, the Biden administration export controls on China, which obviously affects the chip industry and the tech supply chain here in Taiwan. So there are massive implications. Do the people here in Taiwan want to continue with the status quo of that DPP party, which has held the office of president for the last 8 years? Or are they getting tired of what the main opposition party, KMT, is saying? They are stoking the flames of possible war. So it's very interesting if voters are scared by that, or they're more scared about coming back into more of the fold of mainland China. So lots to be decided between now and when polls open in the morning.
I think it's very interesting when you set the table of why you stayed late, why we're covering this. This is a $10 trillion risk to the global economy. That's the fact that's in the story. This is way more than anything that's at risk in Ukraine or anywhere else in the world. $10 trillion. So interference is something that we're going to spend a lot of time talking about, I'm sure, between now and the end of the year. Danny, here in the United States, you will be with me. Danny will be up early. Is there any signs of interference from China or any other actors?
Well, sure. There's been moves, of course, by mainland China, as they usually do ahead of elections, to remind the Taiwanese voters what's at stake when they actually make their choice in the morning. There have been a number of different military aircraft that have come across the median line, according to Taiwan officials, of the strait. There have been weather balloons, whether they're surveillance balloons or weather balloons coming from mainland China, like we saw in the United States, across the median line, even some of them coming across the main island of Taiwan. You've seen all kinds of I would say, influence coming across in the form of social media on Douyin, which was the mainland Chinese equivalent of TikTok. There's been a number of different measures, but keep in mind, we're in the middle of winter right now. You know, it's not snowing and blizzard, but we're in the middle of winter right now. So a lot of experts are saying there might not be big military exercises in the Taiwan Strait in the days after the election, no matter who wins, but that could be ramped up when springtime comes along. Mainland China and the PLA will likely, according to most pundits, have some sort of display just to remind Taiwan of the bigger military power, the bigger economy across the strait, that you have to make choices wisely. Yeah. Right now, there's no indication that there's any military interference on the eve of this election.
So Manus asked you a question about his good fact. I have another fact for you, which I'm going to be honest, actually also comes from Manus. Manus also picked this one out. Sorry, Manus, I'm stealing it. 5.6% of total value added from the GDP comes from sectors using chips as direct inputs. That's nearly $6 trillion. I mean, you think about the chip giants like TSMC. What's at stake for them, for the essential businesses within Taiwan?
Yeah, I was just meeting with the CEO of ASUS, which is a big motherboard maker. They make a lot of components into the supply chain of the tech world. Obviously, they are concerned. They're concerned as well by their customers in the United States who are basically asking them to not procure the parts from mainland China because of those export controls. You're seeing a diversification, as Janet Yellen has called it, friend-shoring. Even TSMC, the biggest contract manufacturer of chips by far in the world, they are building a new factory in Kumamoto, southern Japan. They're building factories in Arizona. They're diversifying. Warren Buffett divested his entire stake in TSMC. Not because TSMC is a bad company, far from it. It's because of the geopolitical risk here that poses of a possible invasion by mainland China. I'm not saying that's going to happen imminently. Okay. It doesn't make any logical sense for any kind of invasion right now. But again, it is a risk that is out there, and money moves where the risk is less.
I tell you what, Stephen, thank you very much for staying up late, but we've both got backdrop envy. Just whereabouts are you? And it's been a while. Have you been there since before COVID? Since after COVID, I should say.
Yes. Yeah, I've been here for the last week, and I lived in Taiwan 25 years ago or whatever. This didn't exist back here. This is the central business district with what used to be the world's tallest building, Taipei 101. Taiwan is an economy that is doing pretty well.
I was going to say we needed that fun fact. Well, Manus, you know what the tallest building is now from your old home.
Well, because she corrected me in the commercial break, it is, I think, the Burj Khalifa. I think, but of course we could possibly.
It absolutely is.
Stephen, thank you very much. That's our chief North Asia correspondent. Let's see how the numbers break down. Stephen, thank you very much. Enjoy your time in Taipei. A live shot of New York City. It's waking up. It's 5:51 a.m. Coming up in the show, the events of the day. PPI rates high on the card. Good morning.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
This is Bloomberg Brief. I'm Danny Berger in London. Manish Krani is in New York. Now let's get you set up for your last trading day of the week. Here is what's ahead. We're going to be getting U.S. PPI data. That's at 8:30 a.m. Eastern, followed by Minneapolis Fed President Neil Kashkari. He will speak at 10 a.m. Then it's U.S. bank earnings. Bank of America, Wells Fargo, J.P. Morgan, and Citi. Manus, they all report before the bell. And we'll also get Delta reporting too. But at the moment, not a lot of movement from those. It's really the oil companies that are responding to those U.S.-led airstrikes in Yemen.
Yeah, I mean, oil price in of itself is up just over 2%, but you are beginning to see these are the American players pre-market. We've had some moves in the European complex, Shell, Total, etc. But the U.S. complex, there's Brent, Danny, above $80, as you flagged earlier, 3.8% rally on that at the moment. And on WTI, let's just give you a price check. On WTI, we've got 74.90. Danny.
Yes, we're back at $80 a barrel. And I come back to what Michael Hartnett of Bank of America wrote, that there is a potential for an inflation comeback in 2024, that the risk on market is ignoring the inflation red flags, be it the Red Sea or even the CPI report from yesterday, Manus.
Yeah, and just think of the conversation we just had with Stephen in Taiwan, in Taipei, as that election comes. $10 trillion. I mean, that is genuinely an interesting fact of the day. $10 trillion of trade is there. From Danny and I, that's the brief. Surveillance is up next. We'll see you next week.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
It is clear that the Fed has policy in a restrictive place.
The policy rate is certainly restricted, and it's certainly feeding into the economy.
By June, they will have enough information in terms of how restricted that policy rate is becoming.
If the economy slows a lot, the Fed will feel comfortable with cutting interest rates.
There are a lot of rate cuts that are priced in the near term that may not come to fruition.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Your top story overnight. The US and UK launching more than 60 airstrikes on Houthi targets in Yemen. TK, breaking news.
It's the United States, but it's also an allied effort. 4, 5, 6 nations involved, but particularly the United Kingdom. Was fascinating, John, as this story broke, to see the U.S. treatment in the New York Times, Washington Post, Bloomberg, and also in London, the Times of London, the Telegraph. And it wasn't that it was two different stories, but there was sort of the shock of an allied effort. You know, that's how I'd put it.
Houthis responding to this as well now, Tom. All US and UK interests are now legitimate targets. That's their response in the last hour or so. The President of the United States with this to say, let's pull up the quote just briefly. We wanted to send a clear message that the United States and our partners will not tolerate attacks on our personnel or allow hostile actors to imperil freedom of navigation in one of the world's most critical commercial routes. TK, you wonder if this is a one-off or if there's more to come?
Well, I hear more to come within the experts that we're hearing, and to have Norman Rule with us here in a moment. An incredibly busy day, John, but to have Mr. Rule with us again with his CIA experience, I think the brief will be really timely about the more to come.
Things are pretty calm in markets. Let's go through the price action and look at the scores. In the equity market on the S&P 500, you wouldn't have a clue anything was happening. We're down about 1/10% on the S&P. Yields are going nowhere. The 10-year, 397.48. Crude is going somewhere, Tom. Almost 75 on WTI, up by 4%. On Brent crude, back into the 80s.
Yeah, you know, it's a jump here, and what you do on the Bloomberg terminal, folks, is you look at the standard deviation distribution, and I want to make clear that a pop up to 80 is well within 2 standard deviations, but you're getting there. I'm going to say 82, 83 on Brent is much more of a strain to the price system.
It is such a busy finish to the week going into the weekend. Just go through the schedule, the brief this morning, starting with the bank earnings. JP Morgan, Wells, Bank of America due out around 6:45 a.m. Citi at 8 o'clock. All 4 banks, TK, reporting through this morning.
Yeah, and Marcus Stroman to the New York Yankees. I mean, that alone gets you going. But, you know, there's a huge news flow here. John, have we ever seen this? Have we ever seen 3 or 4 banks? It could be in a space of 15 minutes. I don't recall that. They used to spread them out. Give us some breathing room.
It often feels that way. You've got to wait for Goldman and Morgan Stanley
wait
next
a half hour that. But, you know, there's going to be an awful lot coming at you, folks. And what I find interesting here is the partition between these successful big banks removed from the property market, commercial real estate, versus all the other banks, which in a week or two will be just as important a report.
It's not just bank earnings either. Earnings season well underway through this morning. 6:30 Eastern time, you're going to hear from Delta. And the economic data, we had CPI just a little bit hotter than expected yesterday. Tom, this morning PPI, and we'll break down those numbers with Michael McKee, of course, and Mohammed Al-Arian a little bit later this morning.
Ed Jardini publishing last night, I don't have the numbers in front of me, but the bottom line is if you take shelter out of the inflation report yesterday, John, you're 2-ish. I mean, that was the skew of shelter to that little bit of lift there. What are we doing with inflation? Ed Jardini takes out shelter and he says, you know, it's really not all that bad.
To that point, Tom, you can learn something about the data and how the market responds to it. We often say that on this program. Look how bonds responded. Initially, yields up. What happened at the close? Yields down. Bonds rallied through yesterday.
10-year real yield, folks, 1.80 is now a 1.72. And to dip there under, let's say, oil up or whatever, global slowdown, 1.69 would be a shock into the weekend.
Things in the bond market pretty stable. Things in the Middle East, anything but. Joining us now is Norman Rule, Senior Advisor on the Transnational Threats Project at CSIS and former Senior U.S. Intelligence Official. Norman, good morning to you, sir. The first question from us this morning, overnight and through this morning, was that a strike on Houthi rebels or a strike against Iran?
Good morning. The attack was a strike on Houthi rebels. It is an attack consistent with the administration's plan to have a gradual escalatory approach to the region. It certainly will degrade Houthi capabilities. It's unclear to the extent those capabilities will be degraded. It is unlikely to deter the Houthis from future attacks, although the Houthis will likely calibrate those attacks in discussion with Iran to prevent a more significant regime destabilizing response.
Mr. Rule, Nicola Smith in The Telegraph has a really terse essay on the actual missiles that the Houthis have. And what I read out of it is I see the stereotype in the media that this is a bunch of terrorists off on a desert island. That's not the case. They have very sophisticated missiles. For example, the USS Gravely's there, the Arleigh Burke destroyer, and they've got some missiles here of real capability, including ASBMs. Do we underestimate their sophistication?
No, and in fact, it's a well-known fact among the governments of the region and Europe that the Houthis have acquired powerful missiles and, more importantly, training from Iran and in Iran on those missiles to make them a lethal threat to the region.
What is the difference for our ships at sea, at the Red Sea, and frankly, outside the Red Sea today? Now that this attack has occurred by the Allies, what's the new risk to our sailors?
Well, the Houthis are certainly going to sit back and say, what do they have left? What has been damaged? How can they disperse and use other tools? We have to remember the Houthis still have a vast drone fleet, probably some missile capacity, drone boats, and also naval mines. Now, a naval facility was struck as part of the attack profile, but that doesn't mean that we have taken out all of those capabilities. And the Houthis, again, can use those as long as they keep the nature of the attacks below the level that would cause a very significant counterstrike.
Norman, this effort has been led by the United States and the United Kingdom. What do you think we can learn from the countries who were involved and the countries who weren't?
Well, the United States and the United Kingdom, as usual, are very close partners, and their intelligence and military authorities would have coordinated very closely over the weeks prior to this. Within the region, we had support from involvement by Bahrain and the European Union from Netherlands. That doesn't mean these other countries weren't playing different roles for security in the region, but for their own political and security reasons, they could not involve themselves in the attack. And frankly, the United States and the United Kingdom had more than enough ordnance to undertake these activities between our missiles, the U.S. submarine, and the 4 Typhoons launched from Cyprus.
Can you take us into Riyadh and give us a deeper understanding of how Saudi Arabia will be thinking about this moment?
Saudi Arabia has issued a muted response calling for restraint from all parties. The Saudis will probably be pushing a diplomatic initiative to send deterrent messages to the Houthis and to the Iranians. I'm not sure the impact of that, but the Saudis also have to recognize that if the conflict were to escalate, it would impact their security issues, and the international community has not shown much appetite for working against Yemen in the long term. So they have to be careful. If you're going to involve yourself in Yemen, what's the plan? How does this end? And are you going to be with us as long as it takes? And the United States and Europe have not demonstrated that interest.
Norman Rule, Bahrain near Qatar, sandwiched between Kuwait to the north and UAE, Dubai, and Abu Dhabi to the south at the Persian Gulf, the Arabian Sea, I should say. And I'm looking at Bahrain. What is their relationship to the other Arab states? Are they alone this morning, or are they acting in support, with the support, I should say, of the other Arab nations?
Well, there's no opposition to Bahrain's activities. Bahrain is not the largest country in the region, but it consistently shows significant leadership on issues ranging from the Abraham Accords, on opposing what Hamas did on October 7th, and on its support with allied and partner military activities. The Naval NAVCENT, our Naval Command Center in the region, is located in Manama, and the Bahraini leadership is a very supportive and reliable partner.
What is the level of our intelligence this morning? You've been so good at outlining to us how we know what we know. That's always the worry. Do we have good intelligence after these attacks?
The nature of the attacks demonstrates a clear and good understanding of the locations from which attacks have taken place. We have infrared satellite capability that, according to press reports, allows us to understand whence attacks originate. So I'm confident that the intelligence behind these attacks and subsequent Houthi operations will be good and consistent with the past.
I'd love your interpretation of a headline we got in the last hour or so, Norman. I wonder what you think about this. When you hear the Houthis say that all US-UK interests are now legitimate targets, Norman, what does that mean?
Houthi rhetoric and Iranian rhetoric will remain defiant and strong, but again, we're likely to see Houthi attacks against shipping in their neighborhood. Their reach is really not far beyond that. But again, the Houthis are going to want to calibrate this for their own domestic audience and for the region as they move forward without, again, getting another major missile response, particularly one aimed at their leadership. This response was tactical in deterring and degrading activity. It was not strategic. It was not aimed at leadership or destroying all Houthi military assets. And again, we're managing that escalatory ladder, and the administration in London are doing this carefully.
The administration and Westminster will have to manage the domestic reaction as well. Norman, this came from Rishi Sunak, the British Prime Minister, described the hits on Yemen as limited, necessary and proportionate after weeks of dangerous and destabilizing attacks. The electorate, and I think domestically within the United States, within the UK, are going to be increasingly worried about their countries, their nations being drawn into this tension in the Middle East. Norman, would you describe what we saw overnight through this morning as a one-off, or are we setting the stage for a repeat of this through the next few weeks?
The British Prime Minister's statement is accurate and crisply said. We hope it's a one-off, but that's really up to the Houthis. I think what we have to look at is whether a Houthi counter-strike will be symbolic, meant to show defiance, or really something that indicates that they haven't got the message. If the latter is the case, there will certainly be a broader strike by the United States, probably the United Kingdom. But again, it'll be carefully calibrated to move up the escalatory ladder. Neither Washington or London are interested in an all-out conflict in the region.
And Norman,
Iran and the Houthis know this.
At the moment, you're comfortable that there is some kind of distinction between Iran and Houthi rebels, because a lot of people struggle with that idea.
You will note that in the U.S. statement on the attack, Iran is not mentioned, although in any explanation of the attack and the problem set, Iran is always described as being behind this activity. Iran will attempt with difficulty to deliver new weapons and provide support to the Houthis, but the naval capacity in the region will likely disrupt that. I think the broader problem is going to be the capacity of Iran's embassy and the people involved to provide intelligence and counsel to the Houthis as they deliberate their way forward. But that's the nature of the relationship between Iran and the Houthis.
Norman, we're very lucky to catch up with you, sir. Thanks for your time. Norman Rule there of CSIS. You're seeing the consequences in the market, turn to crude by 4%. I wouldn't call this a major move, Tom, but we're back in the 80s on Brent crude.
Buttressed up against 2 standard deviations. As I said, 82, 83 gets my attention. We're not there yet. People saying that oil's surging, I just think that's not the right word right now.
Not quite, but we're seeing business. We're seeing business have to respond to this, Tom. The disruption in the Red Sea. First, we started to see it affect shipping, AP and Immerse, the container shipping giant. Then you start to see it affect business on the ground in Europe. This from Reuters on Tesla, partially halting work at the Model Y sport utility vehicle plant near Berlin, because suppliers have got to shift transport channels off the back of this tension in the Red Sea.
Yeah, Lee Klaskow's world class on this at Bloomberg Intelligence, and we had a lot of perspective yesterday. And there's a big number on the disruption of the billions and billions and billions of dollars. And as he made clear, it's 10, 11 days around the Cape of Good Hope. You know, it's just longer, period.
We've got a lot to get through this morning, not just our top story. We've got to talk about bank earnings as well. Ken Leon of CFRA reacting to bank earnings a little bit later on this morning. JP Morgan, Bank of America, Wells Fargo, all due in the next half hour. After that, we've got to talk about Citi. We need to talk about PPI, the economic data, Tom, of the last 24 hours.
My message is each of these stories is different and unique, and Leon and our team will slice that apart.
Here are the scores this morning on the S&P 500. Equities pulling back just a touch. We're negative 0.1%. Yields are higher by a single basis point, 3.98 on a 10-year, and crude rallies advancing 4% on WTI, $75 a barrel on Brent, back in the 80s. From New York City this morning, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The 2024 nominating contests are here, and the candidates are making their cases to voters in Iowa ahead of the caucuses. Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in Iowa, only on Bloomberg. Context changes everything.
I think March is probably too early in my estimation for a rate decline, because I think we need to see some more evidence. The December CPI report shows that the job isn't done yet, and that we're on the FOMC, as you know, are committed to finish the job of getting inflation back to our 2% target. But the important thing to realize is that disinflation that's been happening has happened while the labor market conditions remain healthy.
I think March is probably too early. That was Cleveland Fed President Loretta Mester speaking with our own brilliant Michael McKee, signaling a later Fed cut than some of the markets may be anticipating. Citi, Andrew Hollenhorst echoing some of that yesterday. We continue to see March as too soon for the start of rate cuts. From New York City this morning, good morning to you all. The state of play in financial markets looks like this on the S&P 500, heading towards a week of gains this morning, just a touch lower. We're negative by 0.1% on the S&P 500. Into the bond market, yields are higher by a single basis point, 397.86. And crude on the move, Tom, following those strikes by the United States and the UK, very close to 75 on WTI, 74.90, up by 4% here. Brent crude back in the 80s, $80.40.
Thank you to Norman Rule for being with us. Seems almost day after day, but with his expertise, it's just hugely valuable. John, you know, I look at the inflation debate and what Michael McKee accomplished with Loretta Mester of Cleveland. And to Ed Yardeni, I guess inflation sort of disappeared, particularly goods disinflation and outright deflation, except shelter. And somebody needs to explain to me how the Fed can act before they see shelter come in. They have to wait to see the shelter vectors turn around. I mean, it's just, that's borderline religion.
So go through the calendar, TK. March feels too early for you based on that?
I want them to cut in January, but that's not the issue. The issue is they're ex post, they're after the fact, and they just have to wait to see shelter crack. There's no end if or buts about it.
I think some people agree with you.
Yeah, I mean,
whether they should be worried about what's developing in the labour market, overall headline payrolls growth looked pretty decent. I think some people would point towards some cracks elsewhere, but overall the headline number still looks pretty good.
And we need more data that'll keep us going, to say the least. This is an important interview now. We get out front of bank earnings this morning, but also on the equity markets with all sorts of good experience with Franklin Mutual shares. Katrina Dudley joins us this morning. Katrina, I love how you push against the earnings are going to be better than people expect idea. Help me with that. Are earnings going to be tepid, and why is my key question.
Look, if we look at earnings growth expectations going into the year, they're at about 11% growth. So that's a fairly, high rate of growth given some of the headwinds that we're talking about. We are talking about interest rates and the full effect of interest rates coming through. You've talked about the strength in the labor market, and that strength in the labor market still is not reflected in corporate earnings because you're not really seeing those wage increases come through. So there's some of the pressures that we think are going to mean that earnings growth is going to come in slower than the market expects.
I mean, how much slower? I mean, we're talking, I think we're modeling out mid-single digit, and there's all sorts of people, including Bloomberg's Gina Martin-Adams, making clear we could see a nice surprise beginning with this morning's bank earnings. You're just flat out pushing against that, aren't you?
We are. We're flat out pushing against that. I think that, the expectations are actually pushing closer to the double digits on earnings growth. We think that, single digits will be one of those things where a CEO can kind of do that proverbial tap on the back. And because they've got a lot of headwinds to deal with, and we think that the markets are tepid. We don't think that the ability to get pricing power is as strong in 2024 as you saw in 2022 and 2023, where we had supply chain issues, we had shortages of product. And so that the price mechanism is the way that you offset these cost headwinds. We're not sure that they can do that.
You've got 5 surprises to start the year. I just wonder if what's developing in the Middle East right now is one of them.
It isn't. I think that we look at what happened in 2023, and we already have seen escalation around the world in various pockets, and this is just a continuation of that escalation. One of the, so our 5 surprises are actually not, more turmoil in the world. I actually have to say that I hope for less turmoil in the world because, we're going into a cycle. One of the surprises we did talk about is the election cycle that people are not focusing on. We're here in the United States. We know what's happening in November, but people around the world are going to the polls, and that is going to cause some level of turmoil across the world.
Are they a group of idiosyncratic stories, or is there a broad theme connecting these elections?
I think in terms of the connection of the elections to the United States is there's a lot of reactionary policy. That's one of the things that we saw in 2023. We saw we saw the United States come out with green policy, and then Europe updates its green policy because countries are realizing they're almost like little mini companies. They need to be competitive. They need to have policies that are competitive. As we go through an election cycle, we will have new policies coming out of new candidates, and that's going to change the world order.
I digress, but it's in the ether right now, and that is not the death of ESG, but a readjustment of ESG. Speak for Franklin Templeton, speak for all your Heritage Mutual series. Is ESG a once-off of a few years ago, or is it forming into something new and different?
I think that ESG is now integral into the investment process. When I started my career, and it was 20 years ago, we were very heavy on the G, the governance side of things, so holding companies accountable, looking at pay packages, making sure that there's that linkage between corporate earnings. Now we're focusing on environmental. We're looking at what does their product set say, how well are they positioned on an environmental basis. We're looking at the social, how are they positioned as it relates to their workforce. But it's part of the analysis. It's no longer a separate category. That's the difference.
I'm fascinated, John, what you and Lisa and Anne-Marie see in Davos here in the next week about a readjusted ESG off of the enthusiasms of two winters ago.
I think most people would agree on the ultimate destination set by governments around the world. I think where there's some disagreement at the moment, Katrina, is on the speed at which we get there. Do you see some companies moving too quickly than others? We had to see a move from Hertz yesterday, dumping 20,000 EVs, but simply because the demand wasn't there. Are there some companies that are going too fast?
I think in the Hertz example, it's a reflection of the fact that if you think about when you're renting a car, you don't know the area you're going to. And so we need a technology that can help people map out those charging stations. So it's really showing a gap in the market where we need to have the technology solution to support the kind of hard solution, which is the EV reducing down the emissions. So I think that that's the reflection. In terms of companies getting faster, you have to. You cannot be the last person closing down that coal-fired plant.
We had a conversation yesterday with someone who pointed out that the conversations we're having here in America are very different to the ones taking place in Europe and China. The EV reality checks that we're getting at the auto manufacturers, GM, Ford, the car rental companies, Hertz yesterday. Do you hear any of this whatsoever over in Europe?
In Europe, I think in terms of ESG, they're much more developed in terms of the narrative. And the companies, if you look at the company reporting, you look at the infrastructure and everything, it's much further along and it's a much more developed narrative. And I think that that's what's reflected in the conversations. As you head over to Davos, you're going to be really in the center of things, hearing about what CEOs are saying and what CEOs are talking about as it relates to ESG. And I think that that's where you're going to get the barometer of how important it is to 2024.
I totally agree with Katrina on this, John, and that when we were in London, I was unprepared for how green London is versus the American dialogue, and that doesn't even speak to the continent of Europe.
I think that, that the fact is, though, that London's much smaller of a city. And that's one of the drivers of things like EV adoption, because that there's not that many miles or kilometers that you need to drive.
I got a Tesla for sale. Are you interested?
The range anxiety is real, Tom. It's real. In this country, it's real.
And they had a great essay. I'm going to give credit to Business Insider. I don't know where I saw it. You go out and you actually rent a Tesla from Hertz, and you've never driven an EV before.
It's true.
And a lot of people were doing that.
It's true. Katrina, good to see you. Katrina Dundee there of Franklin Mutual Series. Busy 30 minutes coming right up. Bank earnings in America. You'll hear from JP Morgan and Bank of America. Gerard Cassidy of RBC Capital Markets joining us very, very shortly, looking ahead and reacting to some of that as we look ahead to more data later this morning. PPI, 8:30 Eastern Time. From New York City, this is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Live from New York City, earnings just around the corner. JP Morgan, Bank of America on deck. Going into it, the scores look like this on the S&P 500. Futures lower, negative by 0.14%. On the NASDAQ, down about a third. Heading towards a week of gains on the S&P, higher by something like 1.7 or 1.8%. In the bond market, 2-year, 10-year, 30-year. Tension in the Middle East. You do not see it in the bond market. Yields are higher by a single basis point, 3.98 on a 10-year. You see some of it in crude. Crude, back in the 80s on Brent. Brent this morning, $80.55, up by a little more than 4%. WTI, Tom, reclaiming 75.
Yeah, it's banded up there against 2 standard deviations. It is not a surge, but it's a nice lift in price off of what we see, the Allied effort against the Houthis. But just to be as simple as you can, John, 82, 83 gets my attention in terms of a more robust language. I'm not there yet on Brent crude.
Let's get you the latest this morning. Under surveillance, escalating tensions in the Middle East. The US and UK launching more than 60 airstrikes on Houthi targets in Yemen. The biggest attempt yet to stop the Iran-backed group's attacks on ships in the Red Sea. The president saying the attack sent a, quote, clear message. The Houthis vowing to respond, Tom, with counterstrikes.
We're learning. It is about the technology, but also the Allied response, including Bahrain, is there as well, maybe representing the Persian Gulf. But it's a group effort. And as you mentioning the Prime Minister early this morning, very clearly, Britain alongside the United States. We're not alone on this.
Well, let's get to the quote from Rishi Sunak, the British Prime Minister, describing the hits on Yemen as limited, necessary, and proportionate after weeks of, quote, dangerous and destabilizing attacks. Just how limited, Tom, will this be?
Or what is the next one? Is it limited? I mean, this was Norman Rule, who's the expert on this, making clear this was a tactical exercise and not strategic. And you wonder of the risk of further tactical attacks or responses, I should say, and does it shift to becoming a broader, more strategic effort against the Houthis or against Iran for that matter?
Already talked a lot this morning about how stacked the calendar is just for this morning and the next 30 minutes or so. Earnings minutes away from JP Morgan, Bank of America, Wells Fargo, all due out this hour. Citi out a little bit later this morning. The banks, Tom, bank stocks enjoying a bumper fourth quarter. KBW Banking Index up almost 25% since October.
I'm glad you mentioned that. I guess there's some challenges here on costs. They're all going to come out within 2 minutes of each other and make for the worst 20 minutes in surveillance history. But, John, you know, I look at this and I go, once again, JP Morgan's going to really undersell the profit machine it's begun. Even if they announce layoffs, cost reductions, whatever, it's like, oh, we didn't mean to make those tens of millions of dollars.
And then raise the outlook, which is sometimes what happens. We've got no idea if that happens anytime soon, but we're about to get numbers from them in just a second together with Bank of America. Tom, the latest on BlackRock. We've got a deal this morning. Buying Global Infrastructure Partners for about $12.5 billion. The acquisition is the biggest deal in more than a decade for BlackRock and will make it one of the biggest infrastructure investors. Coming up a little bit later, 9:45 Eastern, Bloomberg's David Weston sitting down with the CEOs of BlackRock and GIP.
Mr. Ogunlesi is well known from Credit Suisse days long ago, and I believe McKinsey. But what's interesting here, John, is infrastructure here, folks. Big topic at Davos, I should point out. Macquarie sort of leads the way when we talk to Thierry Weissman, among others. But John, what's interesting here is the acquisition today of Lawrence Fink of Gatwick Airport. Can we talk about the drive from the city at 4 p.m. to Gatwick Airport? Would you explain to our American audience the LaGuardia of the United Kingdom?
If you grew up north of London, to go down to Gatwick was like JFK on steroids. Yeah. You know, you get caught in that traffic, not great. But I think for BlackRock, Tom, after the job cuts that were announced earlier this week and the big changes that he's looking for in the asset management industry, to go into private markets, to go into wealth, to expand there and make a big acquisition like this, I think is more than noteworthy this morning.
You wonder how many people are bidding for this. It also includes a Suez operation. You wonder if that's around the Suez Canal as well. Let's dive into this right now. And the banker news, we're going to try to get this in here at 6:33 Wall Street time. Gerard Cassidy joins us. He's large cap bank analyst at RBC Capital Markets with decades of experience. What will the cost reductions be, Gerard? I mean, I get they're going to come out and they're going to manage that, but is 2024 beginnings with this earnings report a year of cost reductions for these major banks?
Tom, I think there will be an increased focus on reducing costs, no doubt about it. The banks are striving for positive operating leverage. And as you know, the net interest revenue numbers will start the year off on the weak side because of the margin pressure that the banks are experiencing. We expect that to inflect, though, sometime in the first or second quarter of 24. But to your point, we do expect to see further announcements of downsizing of personnel. We've already had some announcements, as you know. PNC is an example. Of course, Citigroup's got a big restructuring going on. So yes, Tom, we do expect to hear more about reducing costs.
It was a good Friday, folks. I Zelled in Offspring. Gerard Cassidy knows Zelle works. How's the digital banking battle? Who is winning the digital bank wars?
Tom, all of the major banks have incredibly good digital products. You know, when you think about the introduction of the iPhone back in, I think it was 07, 08, it really has transformed banking like so many other industries around the world, especially on the consumer banking side. But as we know, you can buy a very strong product off the shelf, which allows the smaller community banks to compete against the likes of Bank of America and JP Morgan with the digital product. And probably, as you know from your own personal experience, there's only a handful of app or transactions we do on a phone. So you don't need all the bells and whistles. It's like the old VHS machines, Tom. We only use them to play tapes and maybe record, even though they had all those other bells and whistles on it. Same thing with digital apps.
He busted my chops.
Just a little bit.
He knows you have no clue what we're talking about.
I remember VHS, Tom. I was around for VHS.
Well, that's good. Sure.
JP Morgan and Bank of America just around the corner. Before we get there, Gerard, let's talk about how to navigate these numbers from B of A, the one-time items you're anticipating, how to really get a sense of the underlying business, the strength of the underlying business, what we look for.
That's true, John. We're going to obviously, exclude the one-time items. Everybody's going to have the big FDIC charge, you might recall, from what happened last spring with the failures. So that's a one-time item that the banks will incur. But it's really going to come down to the core numbers, and that's going to really focus on two areas, the net interest revenue growth and fee revenue growth. And within the fee revenue growth, of course, with the big universal banks, we're going to be very focused on the capital markets numbers, especially for read-throughs for next week when Goldman and Morgan Stanley report.
IB's been really soft. You know that, Gerard. I'm just wondering, where the pie hasn't been getting bigger, which bank has been getting a bigger slice of that pie? How are they outperforming relative to other banks? Who's winning?
Yeah, it appears that Bank of America is showing the best improvement of taking a bigger piece of the pie. It's somewhat difficult on the trading side to really get a good handle on who's got the better market shares. The geologic numbers help us on the investment banking side because those are publicly reported numbers, and those are good estimates that Geologic has. And in that area, the dominant players, of course, are Goldman Sachs, JP Morgan Chase. And so we'll see if Bank of America or Citi can creep up in their market share in that area as well.
Gerard, are they going to undersell their success here? It's not a joke, folks. I'm serious about it when I say they almost have to apologize for their concentration and their success down the income statement. Is it the same old this time around with these four reporting?
I would say that they are going to be very straightforward about the efforts that they're doing, the success that they're having, but also pointing out, Tom, that they're not only making money for their shareholders, but they're really investing in their communities. You know, the banking industry never really receives any credit for the amount of volunteer hours and money that they donate to communities around this country. And so it's a win for everybody when these banks produce strong numbers, and they have been producing strong numbers, these big four banks. And I expect today we'll see some really impressive numbers.
Jared, I believe this, and I've said this from the day I walked in the door at Bloomberg. We don't understand how big these people are. I just added up an approximation of how many people they have. Summed together, these four banks are 989,000 plus employees. A lot of that's retail banking. Where's that statistic in 5 years?
It's going to be interesting. I think that number, depending on how well they can grow, will probably be flattened down because of the expectation over the next 5 years of increased use of artificial intelligence to really make the banks more efficient and more profitable. But nobody should expect those numbers to be down 20 or 30% because of new technologies. These companies, it's a people business, Tom, as you well know. Financial services is generally a high-touch business in many areas. There is opportunities for digital banking, as we know, but it's not a total elimination of the human touch, which is an important part of banking.
Jared, stay close. Sit tight. We've got some numbers in just a moment from Bank of America and JP Morgan, Wells Fargo, Citi, all coming up later this morning. Going into it, if you are just joining us, welcome to the program. Equity futures on the S&P 500 just slightly negative. We're down by 0.2%. The tension in the Middle East continues to build. Crude is up by more than 4%, $75 on WTI. On Brent crude, we are in the 80s, $80 and about 70 cents. With us around the table to break down these numbers, I'm pleased to say, is Bloomberg Sonali Basak. Sonali, four big banks, four different stories. What are you looking for?
What is going to turn around the story for Bank of America, I think, is an interesting question. We started there. Can you imagine, John, that Capital One last year was up 42% and Bank of America only up 2%?
Why?
Because people are borrowing on their credit cards. If you think about it, on one hand, it's that strict balance between being able to borrow and being able to not lose money on those loans.
Okay, but to be careful here, Moynihan has to come out today. Does he have to address not concerns or fears, that overdoes it, but just a study of Bank of America's liquidity and solvency position?
Well, he does not, because Bank of America has really taken care of that problem over the last decade, haven't they? And, you know, you could make an argument that investors maybe want Bank of America to take on more risk.
Right.
Remember, they have piled a lot of their balance sheet into bonds when yields were next to nothing. And so they have had that money tied up. That balance sheet is starting to roll off quite a bit, and you're starting to see their held to maturity losses starting to shrink as well as rates rise. Or rates come down rather. So they want them to put that money to work. Remember, their average FICO score is higher than some of these riskier borrowers here. But does that mean they want them to lend harder? I think that this is the balance question of the banks, especially as delinquencies start to rise on credit cards. How much risk are you really willing to take on as a bank?
Today will be all love and kisses. What happens in February? Do we see a lot of right sizing and rationalizations? Do we see announcements, or is it dribs and drabs? grabs through the late winter.
We've been talking about this, the culling. We have seen stricter cullings, right, at the end of last year.
They do that in media, too.
Brutal.
It is brutal. It's absolutely brutal. And remember, we saw so many job cuts last year. The hope this year is that things start to turn around and they can keep more people on staff. To Gerard Cassidy's point here, you did see Bank of America gain a little share in investment banking. And they also bank in the middle market, where a lot of banks don't have that wide American footprint. And deals happen faster when they're less than $10 billion.
We've been talking about banks for the last 15 minutes, haven't mentioned last spring. Have we left that all behind now, the bank failures of 9 months ago?
Yes. I mean, no, in the sense that you are going to see those FDIC charges, but the idea of the severe crisis that people felt back in March, they don't feel that now. But we do see pain still, and you'll see that in places like commercial real estate. By the way, you'll also see it in places like auto and credit cards that could get messy in the coming quarters, as we see from Fed studies that delinquencies are rising.
They all come out with their different PowerPoints. What's the first thing you look for? I mean, like 42 pages, let's say. What's the first thing Sonali Bassett goes to?
I go to, you and I both do this, we go to the returns. At the end of the day, it comes down to the returns on tangible common equity. It comes down to the returns on equity. It's the best clean way to gauge the banks, but the profitability.
It's basically, except for Citigroup, big double digit, right? Is that a generalization?
For JP Morgan. Everybody else is wavering against that double digit number, and it comes down to the costs as well. Those returns can't be gauged if you can't keep your costs under control. Interestingly enough, Bank of America had made that great move to increase their minimum wage to $25 per person in the next year or so, in the next couple of years. So they do have a cost base, a big employee base that they have to contend to, while also managing how to bring in more net interest income at a time where people are overextended on loans.
I don't think we've ever done this, John. It's 6:44 Wall Street time, and we're waiting for 4 separate button pushes at 6:45. This is
arranges
unfair.
this, Sonali? Whose fault is this?
Whose fault is it? I remember that time Bank of America came out at 5:45 in the morning.
But Gerard Cassidy remembers when there's carrier pigeons. I mean, you know, the pigeon.
That's how they used to deliver the
bird
earnings.
would fly up from New York to Boston, and he'd be at Tucker Anthony.
Back in the days of VHS.
With a big net out the window to capture the bird.
We'll be drowning in these numbers in the next 5-10 minutes, Sonali. Just quickly, briefly, what do you make of that BlackRock deal this morning?
BlackRock has been struggling to grow its alternatives business, and to do it in infrastructure is the one place it makes the most sense. If you think about their competition now, it's Brookfield. And you will wonder if they will dig deeper into those other alternatives like private credit that you've seen others really dive into.
Would you suggest, we're going to be very careful here with the time, folks. We'll give you the banks the moment they come out. John will do that. I'm fascinated if this was a bidding war. I mean, Gatwick, Suez Canal, whatever it is, there's different there. And the basic idea to me is everybody else must have been bidding as well, right?
These alternative asset managers, when I talk to folks in the market, they're all up for sale. Everybody is up. Everyone is
Is that
looking.
because now money costs something and everybody's for sale, right?
And scale matters. Unfortunately, scale matters. So if you're not big enough, then you're not invited to the party.
The push into private markets has been absolutely phenomenal. I want to bring back in Gerard Cassidy of RBC as we wait for these numbers from JP Morgan and Bank of America. Gerard, the competition, private markets, debanking, are these guys starting to eat the lunch of some of these big banks on Wall Street?
I would say, John, they certainly have increased their competitive positions because many of the big banks that are regulated by the Federal Reserve, the controller of the currency, they've been de-risked. Following the financial crisis, as we all know, the Fed made a push to de-risk the large banks, and that's what's happening. But all in all, the shadow banking industry has been around, as we all know, for 40 years, and it has taken over a very large position of providing financing for companies in this country. It has intensified more recently, as you pointed out, John. And so the banks are competitive, but the private side has certainly taken a leg up more recently.
Hey, Gerard, the numbers drop for BofA. Let's get to those numbers. There's a couple of one-time items in here that you need to strip out to really gauge the underlying business. You're not only getting a fuller picture of what's dropping. The stock is right now. We're down 5%.
They missed on a lot of critical figures here, going down to the core items here. For example, in trading, where you've seen them really punch above their weight, they did come in below estimates on fixed income as well as total sales and trading revenue. Importantly also, they came in below estimates on net interest income. This is what we've been talking about, their ability to bring in lending money at the time when you do see consumers still borrowing. Are people going to slow down their borrowing activity if they feel overextended? The outlook for that is really important here as we wait for further communication from executives here. Provision for credit losses, while that came in below estimates, John, you did see charge-offs come in above estimates, which means loans are starting to sour just a little bit more than Wall Street expects.
The statement comes out, John, and is a generalization here, and Shanali and Gerard are the pros on this. Return on average tangible common equity goes from a 15-ish to 13 for Bank of America. So there's that key ratio ebbing away a little bit.
Wells Fargo coming out as well, but let's just sit on the trading numbers out of Bank of America. Just for a beat, Shanali, 4Q trading revenue, as you pointed out, 3.75 billion, the estimate 3.84. FIG trading, can break it down from FIG trading to equities trading. FIG trading coming in at 2.21 billion, the estimate 2.4. Equities at 1.55, the estimate 1.44. What would you read into that right now?
They had 0 days of trading losses. On one hand, that is great for a bank. On the other hand, remember, prime services, the ability to service asset managers and hedge funds, super competitive. Goldman has been trying to eat away at everyone's share. And so watching into next week how trading falls across the pack will be important. How much risk are you willing to take on in this volatile market is the question for these banks.
Sally, global markets, Bank of America, 0 trading loss days in 2023. Is that good or bad? I mean, I guess they're bragging about that, but does that really mean they took no risk on their desk?
It is a good thing. You don't want to see these banks losing much money. But to your point here, at this point in time, can you afford to lose a little bit of money? That is a big question here. It's a tough balance. You have to remember, we're living in a time where non-bank market makers are gaining a lot of share. Look at those Jane Street numbers, for example. Citadel Securities, we don't know what they look like full year. And remember, guys, trading activity bounced back at the end of last year. And so Bank of America's competitive positioning, we have to wait for everybody else's numbers, but you want to see if they are kind of holding their ground against the big guys.
More numbers. Wells Fargo, I promised you those just briefly. 4-quarter revenue, 20.48 billion, the estimate 20.35. Their stock is down by 2.6%. JP Morgan up next. We'll go through this piece by piece. 4Q investment banking revenue, 1.58 billion, the estimate 1.72. We talked about trading revenue over at Bank of America. Let's do that at JP Morgan as well. Equity sales and trading revenue, 1.78 billion, the estimate 1.93. FIC comes in at 4.03 billion, the estimate 3.84. There's a ton to get through here with JP Morgan. Just the early stock reaction, down 4%. Shanali, what do you see?
Yeah, the interesting thing here is investment banking is not jumping back as quickly as anybody expects. Remember, even if deal making came back at the end of last year, you're not seeing the banks clip those fees yet from this activity. It takes a while for those fees to float in. Remember, equities also below estimates. This is another competitive place on Wall Street today.